Perfect. Well, thanks, Don, and thanks everybody for joining us today. As Don mentioned, I want to kick off this series really going over the details of what is an ETF, what are the potential benefits of the ETF, and how can you utilize them in your portfolios? Because we think this is an excellent opportunity to one, get invested in the markets, but the question that we always get from clients and individuals is like, how do I get started? And so hopefully through this webinar, and if we go to the next page, we could talk through all of those things. And maybe if we go one step further, so the question that we want to answer right off the gates, and I'm sure there's a lot of folks on the line that already know this, but we do want to make sure we level set with people on the next slide here, is what is an ETF? And so an ETF is an exchange traded fund, and it marries the beauty and the benefits of an individual stock, right? The ability to trade at any time during the trading hours of the day with the benefits of a mutual fund, right? A diversified, professionally managed portfolio that is managed by folks like us here at BlackRock and at iShares. So again, just as a quick reminder, think of it as a mutual fund. It's professionally managed. It's diversified portfolio, and it could be stocks, it could be bonds, alongside the ability to trade that at any time during market hours. And so when we think about ETFs on the next page, I think the incredible stat that I like to hear, or that I've heard, is that there are 3,000 ETFs, over 3,000 ETFs in the industry today, with over $9 trillion in assets. And although some people think maybe it's just buying the S&P 500 or the Barclays Aggregate Bond Index, there's really a wide array of different investment options that you can choose from. And so the analogy that I like to use is that the ETF wrapper, or the ETF industry, has changed investments the same way that Spotify has changed how you listen to music. And so the analogy that I'm about to use will probably both date me and embarrass me. But my favorite song that I listen to is Biz Markie, Just a Friend. And so growing up in the 80s and 90s, the way that you listened to that song was you had to buy the CD, and it was called Biz Never Sleeps. I always remember that CD that I bought. And that was the only way to get it. And that was the only way that I could listen to that song. And if I wanted to listen to that song, I also had to listen to the other songs that were already there and that were already placed in that CD. The same way as investing, right? Historically, we would have to only use maybe an active fund, mutual fund, to buy investments in U.S. large cap equities. But I think the beauty of what the ETF industry has done, and is the same thing as Spotify has done, is now I can customize. Right, I can customize my playlist on Spotify. Now I can customize my investments based on the wide array of ETFs that are out in the industry today. And so, just as a primer here, when thinking about ETFs, whether you want to buy growth in equities or stocks, you can buy a stock ETF. If you want to buy some of that protection or that safety and income, think about bonds. But going beyond that, right now you can buy things like real estate, or real estate investment trusts that generate income from properties and both commercial and residential. You can even now buy Bitcoin in an exchange traded product, or even commodities like gold. So I think, again, it's a wide array. There's 3,000 different ETFs in the industry, and then hopefully there are some, and we're going to talk through some potential use cases and ideas that might meet your criteria. The second thing that I just wanted to point out on this slide, and you'll see it on the bottom here, is that there's different ways that you can access these products, but also the different ways that they're managed. So there are index tracking ETFs that are in the market. So think things like the S&P 500, where you can get a broad market exposure within the ETF, or there are actively managed ETFs where you're outsourcing, or you're giving that control over to an active portfolio manager that can pick and choose those stocks or those bonds or whatever asset class that you're looking for. And so again, just knowing that there's the different options that are out there for you, whether you want to buy that in an index or as an active fund, really important to note. That's been a huge change in the industry over the last few years. And if we go to the next slide, maybe just to put this into perspective and just show you the wide array of products that are out there, I want to just highlight two funds that I think highlights the differences in the opportunity set now that is out in the ETF market. So the first being ITOT. ITOT is the iShares Core S&P 5 or S&P Total U.S. Stock Market ETF. So basically getting the entire U.S. equity market in a one ticker solution, ITOT. You can actually get that for 3 basis points, right? There's a 3 basis point fee on that ETF while owning over 1,000 stocks within it. That is one way that we see investors kind of getting that broad market exposure in a low cost vehicle. But as I had mentioned, there's been a lot of innovation in this industry, and now you can actually access, active managers or active portfolio managers in the ETF wrapper. So a fund like our BlackRock Flexible Income ETF BINC BINC. And so what that's going to do is buy and sell different bonds based on the active manager's view, and that's actually run by Rick Reeder, who's actually going to be speaking at 2 p.m. today. And why I say that there's innovation in this space, Rick is someone that won Outstanding Portfolio Manager of the Year by Morningstar in 2023. Now you can have access to his types of investments in a low-cost ETF vehicle through BINC BINC. And so maybe, after going through some of those examples, what are the benefits, right? Why do we see that $9 trillion moving to ETFs? And I think it's for really 3 reasons. And you can see it on the next slide here. And those 3 reasons being diversification, low cost, and tax efficiency. And so maybe we can move to the next slide, but diversification. I find this to be a really fascinating. So the diversification is the idea that you want to buy a lot of different securities to reduce the potential risk of one stock or one bond really hurting your investment results. And the stat on here, I think, that's pretty staggering, is that if you look, the market over the last 5 years, the U.S. market has done over 100% return. So you've basically doubled your money over the last 5 years if you were invested in the U.S. stock market. That being said, over that same time period, 36% of stocks within the universe actually did not actually lost money over that 5-year period. So again, the broad market has done over 100% return, but 36% of those stocks in that broad market actually lost money. On the flip side, though, if you were diversified, right, if you were invested across multiple securities like you see in mutual funds or ETFs, and you could see that on the right-hand side, 99% of those products actually generated a positive return over that 5-year period. So again, it's not that you might not want to own an individual stock in your portfolio, but thinking about how do you balance that with a broad market portfolio to make sure that you hopefully can generate the returns that we've seen in the markets over the last few years. Again, 100% return over the last 5 years, but 36% of stocks actually lost money. I think that's pretty staggering. I think it shows the benefits of owning a diversified portfolio. So moving to the next slide, thinking about what are the other benefits, and the easy one and the most straightforward is costs. And so, it might not be evident to people on the screen here. I don't know how I look on the screen, but I actually played high school sports. I played baseball, basketball, and football. I was very mediocre at those sports. And one of the reasons why was because I wasn't that fast. And so when I think about those 100-yard sprints in football, I'd probably be in the middle of the pack. But what if I had a 10-yard head start? A 30-yard head start is probably more realistic. I'd probably be at the front, or I'd do much better. That's the way that I think about ETFs versus mutual funds historically, right? They have a head start relative to their peers because they're just a lower cost. And you'll see the total universe of ETF fees on average is 57 basis points or 0.57% versus the average mutual fund at 1%, right? What does that mean? You have a 0.43 or 43 basis point head start relative to a mutual fund. I think this has been one of the biggest trends of why we've seen adoption of ETFs. It's the ability to lower costs in the portfolio, which means that you keep more of what you've earned. And I think that's been a big trend for the ETFs. And then the last one is tax efficiency. Someone that lives in New York City and understands taxes quite well, like that is a drag on portfolios. And if you look in 2023, out of all the capital gains that are paid in the ETFs and mutual fund space, only 1% of the total capital gains are from ETFs. The rest are from other managed products. And so the benefit of an ETF first mutual tends to be that tax efficiency, especially for those that are owning these in non-qualified accounts. An ETF could be a great way to get exposure to the stocks or the bonds that you're looking for in a more tax efficient manner. And on the right side, I think this is a really interesting observation. And so what this is showing is if you hypothetically owned $10,000 over a 10-year period with an average of 11% return, you would actually have almost tripled that money, right? You'd be at $28,000 over that 10-year period. But if you had a 2% tax cost over that same period, right? What are those capital gains? Those are tax costs. The capital gains, you would actually have lost almost $5,000 in your investment that would have been paid on capital gains expenses. So to me, that is a really important, it's actually a bigger cost oftentimes than the fees themselves, is that tax drag or that cost of having capital gains distributions paid to you or forcing you to pay taxes on those. So another reason why we've seen such big growth within ETFs. So now that I've talked to you a little bit about why ETFs and what are the benefits, again, being diversification, cost, and tax efficiency, let's jump into some of the use cases that we see in portfolios. And so the first one, if we go to the next slide, is how do we get started? Well, I think a lot of people look at broad market indexed ETFs, right? Think about the S&P 500, which would be our ETF IVV. What if you wanted to buy smaller companies or mid-cap companies, IJH, or buy small cap companies, IJR? I think the first thing that I would just point out is that IVV, or S&P 500 basis point ETF, has a 3 basis point expense ratio. Just put that into comparison of some of the numbers that I shared before. The average mutual fund is 1% on the US equity market. The average ETF is actually 0.5%, so 0.5% fee. This is 0.03%. This is going to give you exposure to a lot of the names that you know and potentially love, like Microsoft, Apple, NVIDIA, Amazon, Meta, and it's just going to give you a broad, diversified exposure. To me, this is where most of our investors tend to start. They want to think about how do I get step into the market, but think about in a low cost, tax efficient, and diversified manner. Now, the next question that we get is, well, what if I want to go beyond that? Right? What if there are different outcomes or different scenarios that I am worried about or thinking about in our portfolios? And the first one that we're getting, and if we go to the next slide, is risk. We know that the U.S. election is coming up, and that historically has brought volatility to the market. And so the question that we're getting from a lot of clients are, what are different ways that we can manage some of the risks that we think are potentially on the horizon going forward? And so I would break this into two camps. One is people are worried about the concentration risk, right? There's some of the biggest names that I had mentioned previously, like Apple, Microsoft, NVIDIA, are actually getting too big in the market, right? How do I manage that? And you can kind of see it here on the right-hand side. The Magnificent Seven as a percent of the S&P 500 today is 28%. And so I think that's something that is really interesting. So they only make up 1% of the number of stocks that are in the S&P 500, but they make up 28% of the weight. And so one way that you can think about maybe diversifying away some of that risk is something like an equal weight portfolio. And so an equal weight portfolio means that instead of a company being in the portfolio because it's the largest, it just evenly distributes the number of stocks or the weight of those stocks to the number of names. And so each of the 500 or 600 stocks in that index will have the exact same weight. That is a great way if you still want to be diversified, if you still want U.S. equity exposure, but don't want some of that concentration that I'd mentioned. EUSA could be an interesting way to do that. And at 0.09%, very low fee relative to the average ETF at 0.05 or 0.5%. The second risk that we're hearing is more of volatility in the markets or risk of losing money. And so one area that you could think about is our buffer ETFs. And so what a buffer ETF does is think about investing with guardrails. So what if we can utilize options to reduce some of the risk or the potential for drawdowns or volatility in a portfolio. And so what IVVM, or iShares Large Cap Moderate Buffer ETF, does is on a quarterly basis utilizes options to protect the first 5% of losses, right? So if the market's down 5, you would expect IVVM to be flat. If the market's down 10, you would expect IVVM to be down 5%, right? Because it protected that first 5% of losses. On the flip side, these are capped, so you tend to see anywhere from 5 to 7% potential upside. So if the market is up 5%, you might get 5. If the market's up 10, you might only get 5. And so that's another way to really reduce the amount of risk in a portfolio and the amount of different outcomes that can happen. I think that's something that could be very interesting for clients, again, that want to be invested in US stocks, but don't want to take on all of the risk of the market, especially going into the election cycle. And maybe the last thing that I would talk about is income. So if we think about the two things that we're hearing the most from clients is, one, how do I manage potential drawdowns, or potential risk in the markets? And two is, how do I generate more income in a portfolio? Why are we hearing that from a lot of investors? Well, if you think about what's going on in the US, about 6 million investors are retiring each and every year. And what are they worried about? They're worried about protecting the wealth that they've built, and two, generating income above and beyond what they currently have today. And so if we go and if we look at this slide on the page here, this is talking about our buy right ETFs, or our covered call ETFs. And what that is doing, it is buying, let's say, the S&P 500 or IVV, and it's actually writing calls or on that index to generate income. And so what you're doing is you're selling away some of your upside of the market to get income in the portfolio. And just to put some numbers behind it, and you could see the yield for, on the right, that's actually the yield of the underlying portfolio. So the S&P 500 might give you 1.2%. IVVW today is actually yielding 10%. So you can get 10% yield by giving away some of that upside to generate income in a portfolio. TLTW, that's actually the iShares 20-year Treasury Bond Buy Right ETF, doing something very similar. It buys TLT, our long US Treasury Bond ETF, and it's writing calls on that exposure. And I know Don is going to walk through some of the yield figures there, but that's actually yielded over 17% over the last 12 months that we've been running that portfolio. So again, for investors that are less about thinking about the upside of the market, but more trying to generate income, funds like IVVW has yielded about 10%, TLTW yielding about 17% over the last year. So if we go to the last slide, I do want to just drill in a little bit deeper onto covered call ETFs or buy right ETFs, because I do think this is really important for folks that are looking to generate that income. I kind of touched on it before, but what you're doing with a covered call or a buy right ETF is that you're buying the underlying exposure. So you can see that on the left here, long underlying ETF, and you're short, or you're writing a call. So you're writing a call option, which means you're going to give up some of your upside to generate income in the portfolio today. And so a lot of folks might be on the call today that already do this in their portfolios, right? They write call options on their current holdings. This is a way to do it in a more efficient, low-cost manner. So instead of you doing that, we can take some of that operational hurdles away. IVVW, our S&P 500 buy rate ETF, is 0.25% expense ratio. Again, this will write monthly call options for you, yielding 10%, or TLTW, 30.35% expense ratio, doing this on a monthly basis for you on the fixed income side. So maybe to close on the next slide, and then kick it over back to Don to maybe demo some of the tools. What is an ETF? Right, it is something that is professionally managed like a mutual fund that has the ability to trade intraday like a stock. What are the benefits of ETFs? It's that diversification, it's the low cost, and it's the tax efficiency. And lastly, how do we get started? Well, it's thinking about things like total market exposure like ITOT, or IVV at 0.03%. Or if you're looking for something unique or different in a portfolio, thinking about maybe covered call strategies like TLTW at 0.35% expense ratio, or things like IVVW at 0.25% expense ratio. Those are ways to generate outsized income if you're looking to complement things like your broad market exposure that we talked about. So with that, appreciate the time today to learn a little bit more about our ETFs, or learn about ETFs. And with that, I'll kick it over to Don to maybe walk through some the tools that Fidelity offers to all of you.
Sounds great. Thanks, Bob. Excellent information. Really exciting. I know I was taking notes the whole time, so I have a full paper of notes from the information you shared. If I'm thinking about investors that are following along, I'm sure they did their best to take notes too. But remember, early we said if you want the slides, they are available. So if you want to access the slides, just click the link below the video viewer, and you should have access to all the different symbols that Bob mentioned and some of the talking points that he mentioned. And now my favorite part of the presentation is when I get the chance to maybe bring it all to life a little bit more with the Fidelity website. So we can go to fidelity.com to think about where can we learn more about some of the ideas that Bob shared with us. Where can we learn more about some of the different symbols that were mentioned? Where can we learn more about what do they hold? What do they do? What do they cost? So let's transition over to the Fidelity site. And Bob, I might lean on you for just the thumbs up if you can see my page. Perfect. I appreciate that. So remember, my role on the team, and I'm coming to you live today from the Burlington, Massachusetts Investor Center, is I work as a regional brokerage consultant, and my role exists all throughout the country to help local Fidelity clients really align their strategy. How do you like to invest with what we have to offer on the Fidelity website? And that's what I enjoy doing most. I'm working on our test account today. So, and again, any of the symbols that we use are for illustrative purposes. I'm going to highlight a few of the symbols that Bob mentioned, and I'll highlight where can you go to find additional information that you might find useful. So before anything, if I'm looking around on fidelity.com, I'm going to go to news and research. And if I scroll down, I'll go to ETFs. Before I even go there, Bob, I'll mention, because this comes up from time to time, just general navigation of our website, accounts and trade, all things your accounts. What do you own? I want a statement. I need a tax form. I want to pay a bill. I want my dividend to reinvest or pay to cash. That all happens under accounts and trade. Planning and advice. I'm in the Burlington office. We have offices throughout the country. This is what we do in the offices. We help with planning and advice. I spend a lot of time on news and research, where I provide education on these different topics. Products gives a good overview of what we offer. And then why Fidelity has all kinds of great talking points to, why would you consider being a Fidelity client? Why would I consider doing more business with Fidelity? All of our tools, awards, protection, all exists in here. So Bob, I'll go to news and research. Oh, last thing I didn't mention, Bob. I'm always using search or get a quote. That's my way to cheat and find it on the website if I can't find it on the website. All right. News and research and ETFs. This brings us to the Fidelity ETF Research Center. Depending what I want to do, it kind of all starts here. So if I wanted to look for a fund, I might come into the screener. If I maybe wanted to track some of the funds, Bob, that you mentioned, I can add them onto a watch list, or I can set an alert. If I want to build a portfolio, I have the ability to build a model portfolio here, whether I want to take some of the symbols to fill a gap in a portfolio or just start from scratch. Maybe I did a 401k rollover. I have an IRA full of cash and I want some symbols to help me get ideas to build a portfolio. The place I'm going to start today, though, is I'm going to come up here to the left where it says enter symbol or company name. And what we're going to do in here is let's start with just maybe a few of the symbols that we looked at today. So ITOT, I'll look at first. That was one of the tickers that was mentioned. If I click it in and hit enter, this will bring us to where we can learn a lot about the fund that was mentioned. So what type of information do we have? And what's the general navigation of this page here? So before anything, I can confirm that I'm looking at this US total market stock market ETF. I can get the most recent price. This is how we refresh the quote. If you've been away from the computer for a few minutes and you want to get it updated, just click on the little refresh button. If I come over to the right, here's volume. We know that's an important characteristic as we're looking at some of these different funds, and there's a lot of trading volume here in this fund. You can see the 52-week range and the day range. As we scroll down a little bit, what are some of the other characteristics that we like to look for? I think you mentioned the expense ratio. So I think you said 3 basis points, Bob, if I got that right. So when I buy one share of this fund, I'm getting, if I scroll down, for 3 basis points, what do we say, over 2,500 holdings, right? And if I want a full list, because one of the things we like to sometimes say about ETFs are they're transparent, we know what they own. You can click on view all holdings and you'll get a list of all the holdings of this fund. I like to look at, when I scroll up, Bob, I like to look at composition. The composition page will take you a little bit further than just the holdings. And I know this is what a lot of our investors are comfortable looking at when they're looking at a lot of the mutual funds that they might consider investing in. How much tech am I buying? How much healthcare am I buying? Is it US? Is it global? What countries? So as we scroll down, we start to see the objective, the prospectus, and all of that type of information exists in here too. So I got to this page under news and research. Then I went to ETFs. And then if I want to just change the symbol, I could type in another one, TLTW. So I took that down as a note. And remember, if you want to see the other symbols, just download the slides. It's bringing me to that page on the composition because I started from the composition. But maybe I want to look at some of those yields that Bob mentioned. How do I know what the yield is today or tomorrow or when I come to the computer? If I click back on overview, now I'm on the overview page for this fund. And as I scroll through, I start to see other important characteristics now. The 30-day yield, that's the SEC yield. What's the total yield? The yield that Bob was mentioning over the last trailing 12 months. Now, if we go to distributions and expenses, I think you said it was somewhere in that 17, 18 range, Bob, and we can see that here. And these hyperlinks have definitions for us too. So we can jump in and get definitions of any of these terms because sometimes when I see letters like TTM or anything, I might not know what that means. So I can click in to see all that type of information right there. Let's scroll a little bit more. Maybe let's look at, I want to look at one more fund, Bob, because I know I get this question from investors from time to time. EVSA was one you mentioned. So let's enter in here. And if I remember correctly, I think you said that this was an, oh, I typed it in wrong. So EVSA. Let's take that.
EUSA.
EU. Oh, my thank you. My penmanship wasn't fantastic. So you can see the benefit of downloading those slides if you're writing like I am. Thank you. All right, perfect. Here we are. So EUSA, equal weighted ETF. And if I click on composition again, now we come back into this fund. And now we can start to see these equal weights like you were mentioning. And I can open up all of them and start to see what this means to the portfolio now if I do, or to the fund, I should say. If I do equal weighting, what does that mean to the market cap of the fund? What does that mean to the sector exposure of the fund? Because all that plays a role in the adjustments to the allocation of the portfolio when you add or remove a fund to the mix of what you're buying and selling here. Bob, I'm going to look at maybe one or two more things, and I would love to open it up for some questions from the audience because I know we got a lot of questions coming in. So maybe I'll just jump into one thing and then I'll take a couple of questions for you if that's fair. What we looked at so far was we came in and we went to specific funds, right? We looked at things that you shared with us. But what if I have ideas and I want to come in and find some of my own symbols that I want to do homework on? So what I can do in this example is we could come in and we could screen. So if I click on screener tools, I can screen for a stock, an ETF, preferred stocks, or closed-end funds. because we're here for the ETF presentation, we know we'll start an ETF screen. And what this is doing here for our Fidelity clients is this is taking the universe of different ETFs and saying, well, what funds do you want to see? Let's find funds that fit characteristics that might be important to you as an investor. I can do this two different ways. I can start over here on the left and I can fund by different characteristics that might be important to me. So for example, if I click on asset class, I have US equity funds. And then if I say I want to look at what else might be important, funds that are lower cost. I know you mentioned that, but that might be a characteristic that's important later on in the filter. So maybe I want to do something like style box. I know investors are very comfortable looking at the different style box. So now maybe I want to look at large cap funds. And you'll see what's happening. Every time I add a characteristic, the list gets a little bit smaller. And there's a lot of different characteristics to choose from. So one that investors are usually comfortable looking at from conversations that I have is the Morningstar rating. And again, if you want to see what the rating is actually rating, there's a definition there for you too. So you'll find with every single characteristic that you choose, there's a definition for you to look at so you understand what you're adding to the filter. And now if I look at this and I say, all right, I do want to look at net expense. If I don't know where that is, I can type it in because that happens to me sometimes. So let's just pretend we want to look at very low. Or if we want to determine what we consider very low, maybe 0.34 we don't consider very low. Maybe we consider very low 0.24. So I can modify that. And now I get a list of some funds, and I can filter by any of these different boxes that we have over here on the right of these headers. And just like what we did earlier, if I just click in, here's one of the funds you mentioned. This brings us right to the page where we can do some of the homework that we looked at earlier. Let me pause for a second. I'm going to take a question or two here for you, Bob. Let's see what we got. Bob, can you talk to us a little bit about maybe like a good mix of ETFs for someone who is already retired? I'm thinking about someone that might already have a portfolio and is looking for a few ideas.
Hey Don, I apologize. My headset kicked out there. Do you mind repeating the question?
So one of the questions that came in, Bob, was for an investor that's retired and looking for some funds for ideas, where might they consider starting?
Yeah, I mentioned it during the presentation, but I do think when thinking about retirement, I would start one is like, do we need to get exposure to the market? And so things like, and you have it on screen here, IVV or ITOT, really interesting ideas just to get broad market U.S. equity exposure at a really low cost at 3 basis points. And I think when you were filtering through, I think I saw a 5-star fund from Morningstar as well. So that's a great way to start. I think for those, and especially for those in retirement, oftentimes we hear people that want income. IVVW is actually buying IVV as the underlying holding, and then actually writing those covered call contracts to get you that 10+% yield that we've seen most recently. So those are the two that I think could be really interesting for folks as a way to, one, get exposure to the market, or two, if you want exposure to the market but get some income on top of it, that's a nice way. And if you think about it, they're both playing off of the S&P 500.
I think it might also be worth highlighting, Bob. Remember, that's what we do here in the investor centers. That's what all of our advisors at Fidelity are doing with clients, is helping every day, mapping out and planning for retirement with all of our investors, mapping out and deciding with you what might be the right investment objective given where you are and what you're comfortable with. And then as you think about managing wealth through our platform, one thing we did highlight but we didn't open is the ETF portfolio builder tool. So if you were looking for, like you said, Bob, if I'm looking for international exposure or fixed income exposure, here's a button here to get started for some ideas. And this will allow you to build a model portfolio when you think about what is the asset allocation that you decided might be appropriate for you as an investor because you worked with your local advisor, and maybe we decided as a team that growth with income was right for now. And I say for now because this is something that is always changing as everyone's financial picture and situation is changing as life events happen. So as we look at this growth with income allocation, what's nice about this is we get the asset mix, but we also get two choices to look at Fidelity and iShares funds. And then we get some funds to consider. And just like we looked at before, we can view performance, view information about the fund, and think about how that affects the asset mix of the portfolio if we take everything or something from this list. Bob, let me go to another page and let me grab another quick question for you. So talk to us a little bit about how would I find AI related ETFs? That's always a filter that can be difficult to do. I have some ideas around that, but I'd be curious if there's anything you want to share with us there.
Yeah, sure. So if you think about AI, there's a few ways that you can play that. I think one is thinking about like the technology sector as a way to play that. So funds like IYW, I believe is the technology ETF from iShares. There are ways to get even more granular. So things like IRBO is our AI and robotics ETF, is a more pure play to get exposure to something like that. And then the last one, I would just think about the AI as a way to just get just broad market exposure, right? So things like IVV that we just mentioned, if you think about the AI revolution, and we completely understand, it's very clear that it's having an impact on the markets. I actually was looking at this the other day. If you look at the S&P 500 with the technology sector within the S&P 500, earnings growth is up over 20%. If you look at the S&P 500 X technology, it's actually down 3%. So the S&P 500 is actually going to get you a lot of that exposure, right? We saw the top names there, like NVIDIA, Microsoft, stocks like that, in a more diversified way. So it really depends on preference. I think maybe the first layer is if you just want to get broad market exposure, it's going to be exposed to the AI theme. The second is if you want to just get broad technology exposure like IYW, or if you want to get really granular with that AI idea, IRBO could be interesting.
Thank you, Bob. Let me ask another question. If you can just share a little bit more about how buy rights work, some of the things to consider beyond just like yield, but, risk or anything that you want to share in that aspect of the buy right strategy.
Absolutely. So if you think about a buy right strategy, as I mentioned before, you're taking the underlying exposure. So like they say the S&P 500 for IVVW, and you're writing a call option on that portfolio. And so what that means is that you are getting income into the portfolio by selling away the potential upside of the S&P 500. And so the two risks that you have there are, one, if the market rallies, you're not going to participate as much because, again, you wrote that call and you took the income in instead of the participating on the upside. So I think think of it as a decision tree that you want to make. Are you looking for upside in the market? Then you might just want to buy IVV. If you're looking to risk that upside for income, IVVW is the idea of a covered call. On the flip side, if the market is down, you're going to be down but a little bit less because, again, you took that income from writing the covered call. So, but you still have the downside participate. You still can lose money. You just you're cushioned a little bit by the income that you generated.
Thank you. Another question, and this is a relative question, of course, but it's more related to cost. What's a good cost? Like what would be considered competitive, or what can be considered a good cost if we're looking at the net expense ratio?
Yeah, I would say it's a relative game, right? So for broad market exposures that I mentioned, I think 3 basis points is the floor has been set, right? And so when you're thinking about investments, it doesn't mean that you have to buy the lowest cost, because that's not always going to be the most optimal investment, but at least it sets a benchmark. So are you getting something above and beyond that 3 basis points for US large cap exposure. As I had mentioned before, covered call ETFs, IVVW is at 0.25%. Doesn't mean that's the fee that you should pay, but are you getting something above and beyond that 25 basis points to justify the differences in fees? So I wouldn't think of there should be an absolute number. It's really going to depend on the type of ETF that you're buying because they all have different averages. But think about what is that average or what is the floor for that, and are you getting something above and beyond that number?
I'll share a little bit on that too, Bob. And I mentioned earlier when we did our filter, costs should usually be one of the latter characteristics that we're adding to a filter. What are the important characteristics that we're solving for first, whether it's large cap equity, US equity, healthcare, technology, AI. Now that we find some funds that fit those initial characteristics that we're solving for, now we can start to look side by side at other important characteristics, volume, expense ratio, maybe even can start to consider the ratings at that point too. So here's one, Bob. I put IVV in, which is the S&P 500. And what's nice about this Fidelity tool is if I come down and click on comparisons, this automatically filters some funds with similar characteristics. So 0.03 as an expense ratio, we can see here is quite competitive and low, but 0.03 might be not realistic if we're looking at a different fund that maybe is a smart beta fund where it has some more work going into it to try and get more desired outcome with different rules than something that's more passive, like a broad index fund like this. So no matter what fund we put in, let's look at EUSA, if I can remember that correctly. My handwriting wasn't good enough. Now we scroll down and we start to see again, here are some funds now with similar characteristics, and we're starting to see return and different expense ratios with some similar characteristics side by side. So I think that's a nice way to look at that. And it's a really good question because I get that a lot when I'm working with investors. And sometimes I get that question with other ETF characteristics too. Let me.
Yeah, no, Donna, I love this tool. No, I was just going to say, think about shopping for an ETF or thinking about your ETF just like you're shopping for any good in your home. Like I've recently bought a car, right? I didn't just filter on the fees. I thought about the quality of the car. I thought about all of these different things that come into play. Fee is cost is definitely a component, but it shouldn't be the only and probably not the first component because there's a lot of different options out there that are also they're pretty close in fee, right? So when you're talking about 3 basis points versus 4, or even 3 versus 6, we're still talking about very low relative fees, especially relative to mutual funds that I mentioned earlier that are on average 1%.
I'm going to take the next question, Bob. I was asked, how we can search for funds by sector. There's a few different ways we can do that on the Fidelity platform. I really like going into our newer sector research page. I don't know if you've seen this or not before. If you go to news and research, and this time I'll go to markets and sectors. From within here, this will land us on the market research page. But if I tab over to sectors, this does a great job of giving us sector research and performance. You can see I can sort by different time frames. Now, if I scroll down, and I'll stick with technology as our example, if I wanted to do research on technology, now I have some companies that you might recognize, some news. I can get an X-ray into what the industry performance looks like. And then if I wanted to search, I can look for a stock, a mutual fund, or an ETF. So now if I click ETFs from here, this is going to bring us into that same page where we were before, but just skip a few steps or maybe do a little work for us. I'll point out that not every fund on this page is the sector. It's going to be technology or more narrow, but within the technology space. So maybe some of the things that you mentioned earlier, Bob, or maybe some of the industries that fall within there. And that'll be the same thing if you're looking at healthcare or financials or anything else. So that's a neat way where we can find funds by sector. You can see it does put net assets as the starting filter. That doesn't mean it's the best or worst fund. It's using that as the initial filter in here. And then if we wanted to add other characteristics like we did before and said, now I want to start to look for some funds that might be lower in cost. And, maybe now I want to look for funds that have a better Morningstar rating or other things that might be important to me. And we can easily get in and get a few funds to start to do a little bit of homework on. Bob, I want to share with investors where we can go to learn more, because there's a lot of questions that go a little bit farther about, tell me more about how I can compare mutual funds and ETFs. If I go to news and research, and if I go to learn, this is our learning center. All of our events are over on the left. Upcoming events, recorded ETF webinars that you might want to watch. We can sort by topic and say, tell me more about ETFs. But I'm a big fan of just typing, so comparing ETFs and mutual funds. Just like that, you're going to have a library of articles, videos, and different ways to compare ETFs and mutual funds. So if you wanted to go a little bit further into this topic of just comparing ETFs and mutual funds to think about which one's right for me, where might I own it? Most investors that own ETFs probably own mutual funds too. Now we can think about what do we own, where do we own it, and planning a little bit more with our advisor team here in the office. Bob, that's a lot of information for one presentation. So we're very grateful to have you here with us today. I'm very grateful to work for you. I know in preparing for this presentation, it was a lot of fun to get to know you a little bit and work with you today. I want to thank all the people that are here with us today. I know there's thousands of people that sign into this event, so your time means a lot to us. We're very grateful to have you as a client. We know the education and insights are really important, and we'll continue to get great content to you from additional speakers. Remember, we have 2 more sessions today, so if you want to join either of the sessions, you can stay on this page. The next session is going to start in about 10 minutes or so. Lastly, you're going to be receiving an email from us. If you have a chance, read it. It's going to direct you to some additional resources that we have. I think you'll find it useful. Bob, let me hand it over to you for any closing remarks, and thank you.
No, Don, thank you so much for having me today, and thank you all for joining. Again, we're really excited about ETFs. As you can imagine, 3,000 different options for you to choose from, $9 trillion in assets. We do think this is where people are moving to, because for the reasons that I had mentioned around cost, diversification, and tax efficiency. So thank you for joining, and hopefully you'll stick around for the 2:00 session.
All right, that's great, Bob. Thank you again. Stick around for the 2:00 session. We'll see you soon.
Amazing. Thank you so much for the introduction, Don. Rick, it's great to be with you.
Thanks, Jeff. I appreciate it. Thanks for having me on.
Pleasure. So excited to have this conversation, and really, for this audience to have the opportunity to engage with you, right? One of the world's leading bond managers, CIO of global fixed income for BlackRock. You've been doing this a very long time. And the audience that we're speaking to today will have a range of levels of engagement with bonds over time, right? So we want to speak to everyone out there here who is a new bond investor, a longtime bond investor, those who are looking for income, those who are looking for diversification, those who are looking for total return. And Rick manages and oversees strategies at BlackRock across the board for the audience. So Rick, why don't we start with maybe a little bit of context setting and kick it off with the macro. There's been a lot going on in markets. There's been a lot of focus on inflation, on interest rates. I think the last quarter has been particularly interesting. If there's three economic trends that you're thinking about as the global CIO of fixed income for BlackRock, what comes to mind?
So, I mean, obviously the big one, like you just said, Jeff, is, I mean, we've inflation is coming down, but it's coming down slowly. And service level inflation has been really sticky. I mean, that is, if you're the Federal Reserve, bringing that down, it's been running. I mean, literally, you have goods inflation that's running year on year. It's been about literally negative 1.5%. It's the goods inflation has been running over 6. So you average them out, core PCE, which is the Fed's favorite metric, is, we get a number tomorrow that we think actually is going to be pretty low. That we think you get a month-on-month reading of 0.10%, but it's pretty low. But if you take year on year, we think it's going to stabilize around 2.6, 2.7. You're still above the Fed's 2% target. So, okay, so now take that as one. Second, by the way, you have an economy that's 70-ish% consumption is in services. Services are really important. It's just so hard to bring it down because the interest rate tool in an economy, services are not like goods or manufacturing. They're not as interest rate sensitive. So the interest rate tool is just not that sincere. So anyway, that is a big one. Second one being, there's something that is epic that has happened and that I haven't seen in my career. And as you said, I've been doing it a really long time. And it's actually scary how long. That we've had a couple of things that have happened. One, we had the greatest transfer of money from the government to the private sector since World War II. What's happened is it's put a lot of money into the private sector, and it's created actually something where the private sector is a net creditor, net lender, because the savings are so high, deposits are so high. So what happens is interest rate tool, when you keep it up at these levels, you're actually coursing a lot of income through the system. But simultaneously, you're creating a two-stage economy where lower income is having a harder time. Small business is having a harder time. You don't have to look past today. You look at some of these retailers, Walgreens, some other issues there, stocks down with 20-something%. But referencing consumer having a tough time. So two-stage economy, lower income, small business, local banks having a tough time. The interest rate really, commercial real estate, creating a pernicious impact on that part of the population. Whereas part of the population, including, and I would say my last point, you've had an aging of the population that's been pretty remarkable. The largest spending cohort in the country today is the 55 and above. Which is, so what's happened is that, when interest rates are high, you actually get income into that group that tends to be savers. Young people are your borrowers. As you age, you tend to be a saver lender. So it's a really fascinating dynamic. Part of why consumption services stays high is that higher income cohort is still in a pretty good place, spends on services. Why is entertainment, recreation, restaurants, hotels, healthcare, insurance, et cetera, auto insurance. So anyway, series of things. I've summarized: service economy, not as interest rate sensitive, aging of the population, consumption at the aging of the population, and then the other being, there is some softness in employment coming through, but it's still a pretty good economy, and it's just not going to slow that much from here. Slower, but not that much slower.
Amazing. You said something there. It's scary how long you've been doing this. I find it comforting how long you've been doing this as an investor. And I think that can give us all comfort that as long as you've been doing this and as much success as you've had at it and the strength of BlackRock's franchise, something that gives us comfort. Though I understand from your experience, it probably feels a little scary when you actually do the math and look at the years. So, you talked a little bit about where we are with interest rates. You talked about some of the indicators. The big question on everybody's mind is, where is all of this going to go? It seems like earlier in the year, the market had more aggressive predictions, now maybe a bit less aggressive. This is sort of the trillion-dollar question, if you will. Forecasters projected the Fed would cut rates in March. It didn't. What are you and the team at BlackRock's expectations for that forward path of interest rates? How are you thinking about it?
So it's a great question. So, I've sat on the Fed's advisory board for 8 years and the Treasury Borrowing Committee. And I will say one thing, that March thing was a little crazy. I mean, the Fed doesn't move that quickly. And, they're pricing the 1.6 or 7 cuts this year. I thought it was extreme. That being said, I also thought they would start sooner. I thought they'd start in May, June. And, my base case now is they start in September. In fact, I just did a call with, we do periodic calls with people at Fed asking what the markets are looking for. And I just did one actually a couple hours ago. And I talked about, September seems like the right time frame. You get another inflation report in there. You get to see more of, and I will say one thing, they don't tell you anything when you talk with them, but one thing I think is interesting is the balance has now shifted to not just inflation. Tell me about employment and what are the indicators in employment you're focused on. So things like job openings, things like wage, you're seeing some improvement in wages. You're seeing, we look at this beverage curve and look at unemployment relative to job openings. And so there's more of a balance now. My sense is there, you have what I think is an economy that's moderating with real pressure in some areas like lower income, small business. And I think my best guess is you have them, you'll start to see, you're seeing a little bit of softness in employment relative to where we've been, that I think they can move in September and then move again in December. You get 2 cuts in this year, but it's definitely not a given. I mean, this Fed is pretty relaxed economy, is operating at a pretty good level. Could you wait? You could wait a bit more, but my best guess is, and by the way, I think there's one critical point when you think about investing in fixed income. The Chair Powell has been very clear about this rate is very restrictive. You can write off, unless something crazy exogenous happens, you can write off that they're raising rates anymore, and that the natural trajectory is to a lower rate threshold. So that, when you're investing in fixed income or even equities, I think that's a really big deal. But I just think you're going to be deliberate. They'll be deliberate in how they execute that.
So, we'll talk a little bit down the road here in this conversation about, choices investors have between buying individual bonds, between buying an index strategy for bonds, or using an active mutual fund or an active ETF. One of the really interesting things that I heard in what you just shared is you had a different view than the market, and presumably you invested around your different view than the market. Why is it that the market would be so ahead of the expectation here? Why did we have that sort of consistency? And how do you, as an active portfolio manager, with the insight that you have a different view you want to express, take advantage of that?
So it's a great question. So one, I think we do a tremendous amount to understand the structural components of the economy. We use a ton of data signals, use AI, we use it so we run simulations on the economy to try and understand where we are. And by the way, it doesn't mean you're not wrong periodically. But part of how we manage it and think through it is we try and establish what is the base case and then try and manage around the extremes of that. The thing that I thought was pretty extraordinary is this view that has pervaded the economic community that we're going into recession. It was just a question of is soft landing or hard landing and how fast. You have a service level economy, and services, in 100 years, there's only been 13 negative quarters of negative quarters of growth, not 2 consecutive, which would be recession. 13 quarters in 100 years. What people spend on healthcare, education, it's very, very stable. And as you have an aging population, and you have more service economy, more digital and more asset light, it tends to be much more stable. Goods economy, go back to 70s and 80s. Goods economy tends to be much more cyclical, much more heavy finance. That the interest rate tool is be much more profound. So anyway, what do you do with that? We felt like you should don't run that much duration or interest rate exposure. Particularly when people are pricing in such aggressive rate cuts. Today, we think one of the things that you think about is, listen, could rates stay here for a bit of time? They could. But we're positioning in a place like we like the 3 to 5 year part of the yield curve. Like you don't have to go way out the yield curve or take a lot of risk in interest rate exposure because the yield curve is inverted. You get so much yield in the front end, your volatility of building a portfolio around that. And let's say we're wrong and rates go higher, which I don't really think is going to happen, but let's say that it does, because I've also learned all my years, you got to, crazy things happen and you're not right a lot. And so if you think about what happens, so if you build a portfolio today that gets you 6.5%, 7% yield without taking a tremendous amount of risk, if interest rates cost you, and if rates go up 30, 40 basis points, you make 50 to 60 basis points a month just holding the income. So the idea being, we've been positioning more for rates coming down but you still don't have to take a lot of long end interest rate exposure, a lot of volatility. So, I've always been a believer. So I'll say two things that is interesting and I've managed fixed income for a long time. I also run some big equity portfolios. In fixed income, I believe in diversifying, create stability. And in equities, I think you want to have, because they're convex to the upside, you want to do more concentration, particularly today when technology is changing. But in fixed income, like build stability today, you don't have to buy a lot of emerging markets. There's some parts of EM that are okay, but just build stability and just try and carry well, create a lot of income, and then run balance and diversification.
Sure. And that's actually a perfect lead into the next question I wanted to ask you. A lot has changed in the bond market. There's the sort of financial crisis to pre-pandemic period, the pandemic period, and where we are now. Very simply for investors who are joining us today, what is the current value proposition in general at a high level for holding bonds, and how has it changed versus what you might have said 3 years ago, 6 years ago?
I've said this is the golden age of fixed income, not because, we're going to make tremendous returns from lower interest rates. If you go back the last 2 decades, interest rates were pretty close to zero or, 1% to 2%. And now you could build a portfolio that creates 6.5%, 7%, and not take a lot of risk. That is like, I sleep better at night. When you can do that. So now think about it. I meet with a lot of endowments and foundations and pensions. So many of them have I need to hit a 7% return target. For whatever reason, there's a lot of magic around 7%. So think about what happened for the last 20 years. I need to own private equity, I need to own venture, I need to do real estate, I need to do a whole series of things to get 7. If you can get 6.5, it's stable. And then, we like equities. I think equities, for a variety of reasons, will keep going. We'll go higher, will do their job. Then, maybe you layer in some things like private credit. But boy, if you got a 7% hurdle and you're not taking a lot of volatility, and I'm using investment grade credit agency, mortgages, AAA CLOs, I can build a 6.5 to 7 and sleep well at night. That is a pretty good, that's a pretty good scenario. And, you go back to 2020, post-COVID and 21, 22, we go back to 2000, mid-teens. And we were buying high yield. You had to buy high yield at 3.5%, 4%. I don't know. Now we can buy, you can buy European high yield and take parts of that, we like double B European high yield, not single B, not triple C. And, as a dollar investor, you're getting 8.5. It's pretty good. It's really good.
So my takeaway here is for investors today, they're able to get greater yield, greater return, less risk at the same time. And I really appreciated something else you said there, which is fixed income isn't going to be the whole portfolio. And that opportunity lets you get a bit more aggressive, a bit more creative in some of the major trends in equities that we're seeing at the same time. So fixed income gives you that sort of ballast, but also that current income to take risk in a way that we just haven't seen in a lot of years.
So, Chuck, can I tell you one thing? So, I get asked a lot about why wouldn't I just sit in cash? I get in bills and I'm, 5.25. But by the way, I think cash should have a seat at the table. But so what's happened now with rates backing up, and now you have a Fed that's going to move down. If you run your scenario, so if you buy things like 3-year investment grade credit or 3-year European investment grade credit, you create a scenario. Let's say we're wrong and rates go 100 basis points higher. You'd only make 3 and change percent. You'd only make 3 and change percent. Let's say rates come down, and then maybe I'll layer in some 5-year paper. You can make 9 in a, without taking, the duration we run, and a bunch of our portfolios, our interest rate exposure, 3.25, 3.5 years. And some are like our ETF are running 2.5 years. We carry in that ETF at almost 7. And so anyway, what's happened is, again, cash should have a seat at the table next to the equity seat. But I also think, would you shift some, and you're seeing that now in the markets for sure. People are saying, okay, I feel pretty good about these rates and I don't have to extend out. And that's why you're creating a better environment, or it's created a much better environment.
Totally. And look, you've referenced different areas of the bond market as we've been speaking, different maturities, different issuers from the Treasury to investment grade bonds with corporates. You mentioned high yield. We even talked a little bit about emerging market bonds. That's a lot for investors to choose from and to think about, right? And so a lot of the investors here with us may have bought individual bonds in the past. That can be a pretty complicated decision. Which do you get? How many do you need for diversification before you even get into some of the very sophisticated conversation you've been sharing with us about the areas of the market and how you move in and out of them during different time periods? I know not all of the strategies, but a lot of the strategies that you manage have the flexibility to move across treasuries, investment grade, high yield on behalf of the investor. How do you think about those decisions, given you have such a broad palette to work with?
So I'll just say one thing. I mean, I've invested myself personally, and I don't really, by the way, I do in equities too. But I feel like with 10 stocks, I get not to say, I don't mean to simplify the equity market that much, but there's the S&P 500, and the S&P 500 is driven, much more so by, say if you took 50 companies, you ran pretty good, particularly in the world of technology today. There's 68,000 fixed income securities. I can't invest personally in it's just so hard. Like I'll own AAA CLOs. Who's the manager? What's the maturity? What's the collateral? Do they own more energy? Like we have big teams that just go through and say, okay, there's this manager, there's this set of collateral. And so what we do is, the other thing about it, fixed income, the bonds either mature at par or they go down. Equities go up because of return on equity and you build book value. So I believe in this idea. I call it make a little bit of money a lot of times, diversify it, find if you just, I believe in the thesis. I know I shouldn't say this, but like if you're running a casino, like how do casinos make money? It's just like a little bit, like you make little pieces all the time. And I really believe in that model in fixed income. Diversify it and just do we like this name versus that one? Have our teams do it in this area. Agency mortgages, do we like 3.5% coupons or 5.5%? 3.5 doesn't have that much interest rate convexity or volatility. And then, how does it marry into the portfolio? And so trying to create stability using your tools, risk management tools, scenario analysis, stress testing. But, fixed income is it is a complex business. And I think, we're really what you're trying to do and what we try and do in our funds, like not trying to knock the lights out. Equities you can try and, there's obviously different growth paradigms, but what we're trying to do is consistent, stable, do it over and over again and use as many, around the world, use as many tools as you can. Like today, arguably the best opportunity is because as a US dollar investor, Europe's not a fast growing region. I heard somebody on CNBC, somebody was describing, they said the US innovates, China replicates, and Europe regulates. And anyway, I didn't say that not to be insulting to any country or what have you, but I thought it was pretty interesting. It was funny. And I thought, but it's interesting, you literally watch it today. Europe is a slow growth, it's a different investment technology. Seems like every day there's a new regulatory framework around it. But I like being a lender. Like I like lending money in Europe. It's stable, and it's a dollar investor. If you, not to get too complex, but if you swap to dollars, buy European assets, swap to dollars, you actually get a currency benefit to the tune of about 150 basis points. So we're buying really good companies in Europe. A lot of the investment grade companies in Europe has to cut rates because they're going to grow slower than the US. And but now you swap it back to dollars, you get some really attractive yields. But that's, as an individual, am I going to buy a European, bond for BMW, swap it back to dollars? Too hard. It's too hard.
Yep.
So
I want to shift gears again a little bit. You've recently started to manage your first active ETF through BlackRock, right? As part of our iShares franchise, the ticker is BINK, B-I-N-K, our flexible income ETF. I know it's a strategy you're incredibly excited about, certainly one that I am as well. Ask a couple of questions individually here, but maybe to start with, because I think it'll anchor us from what we were talking about a second ago. In a strategy like this, how many positions are you able to hold on behalf of clients? Don't need a precise number, but what's the range that you're thinking about? Just to put into context how much you're doing for the investor who enters this fund on their behalf.
So Mike, can I say one thing? It's actually the ticker's BINC, not so by the way, I screwed up. You think I would know that I screwed up on TV once as well, but it's BINC. But anyway, it's hard to like in front of the camera, and anyway, whatever. I think I know every security in my portfolio, but the actual ticker symbol I can get wrong. But so we'll own a lot of different securities. I tend to, we bucket them. Part of what our risk systems are so good at, and so we have so many teams. I look at how much do we have, what percent. So today, how much do we have in investment grade credit, and we have 12% investment grade credit in the U.S. and then what's the percentage we have in Europe? And so I tend to look at it in buckets, but we'll run a good number of securities, and at any given point in time, we could run 1,000 or more different types of securities, but we bucket them, stress test them, and then look at how they interact within the portfolio. But we're really aggressive about this idea of create consistency around what I call beta, like how much it'll move relative to the market. Keep your liquidity really high in an ETF. Keep your yield consistent so that people know exactly what they're getting. And then we'll manage our sector allocations relative to that. But we use a lot of different securities to do it. But to create what I'm super proud. Like in this ETF, we have the same yield as double B high yield, and we're running about 60% of volatility. Why is that? We're buying AAA CLOs, we're buying agency mortgages, AAA agency mortgages. And then we'll use things like securitized, which are these CLOs, or we'll use little pieces of EM, places like Mexico, Brazil, more stable, Indonesia, but then balance it so that we're keeping it consistent. So when people look at the portfolio, day in and day out, they're going to know what they get. And but then how we make the sausage underneath it in terms of number of securities, like that, we'll use a lot of them to try and create as much stability as we can, reduce the volatility for people.
Yeah, and I think it's fair to say that would be very difficult to replicate for an individual investor, even just to buy that number of securities, much less to think about the positioning, and maybe also to reinforce that and some of the value of active investing. You're at the heart of the fixed income investing operation at BlackRock, and certainly for Bank. How many folks do you have to work with across a firm like BlackRock who are contributing, helping you think through that, helping execute? How much IP and individual horsepower and human power is going into what you can do in the strategy?
So in my franchise, I have 500 people around the world. I would say that contribute to Bank, I'd say a couple hundred people. But including with a big risk management team. That is, the way we think about it, that is the sort of the Chinese wall, if you would, of they're looking at our exposures, making sure everything is well managed, making sure you're, all the metrics, not to get into the complexity we call like the Greeks of, your beta, your dispersion, et cetera. A big team that looks at that every day. And then around the world, Asia, Europe, parts of the emerging markets, we have a huge number of people around the world that are looking at these securities, looking at the new issue markets, looking at the secondary markets. And then, we bring it together to try and think through, I'll give you a good example. Like today, investment grade credit spreads have tightened quite a bit. And say, if we believe rates are coming down, spreads could widen a little bit. We're bringing that down. We've increased our agency mortgage position. We like lower coupons. We go to our mortgage team. What do you like? We like 3.5s versus 5.5s. We like, particularly if we think rates are coming down. Rate volatility, we think, can stay low with the Fed. They'll be slow. So, boy, we meet all day and talk about different markets, different expressions, and then we let our teams go do their work. And I'll say to them, we want to have this amount in European investment grade. They go do their work, and then we marry it into the portfolio. So, for example, if we're buying banks in Europe, so we think banks in Europe are more attractive than banks in the U.S. Okay, then we got to keep our concentration to banks oriented more towards Europe. Obviously, agency mortgage is much more of a U.S. endeavor. So it's a lot of work, and we have a big set of teams that helps us do that.
And one of the things you shared there that I loved is, as one of the world's leading fixed income investors, one of the world's most sophisticated fixed income investors and successful, being part of BlackRock, an investor can access this through a strategy like Bank. Even in your position, there's a whole team looking at risk separated from your team, making sure the portfolio is protecting all of the investors involved. I love that part of the story. And I think it's such an important thing to understand with active management. Even one of the greatest fixed income investors in the world, we're still going to have really thoughtful, really appropriate risk controls at a place like BlackRock. So there's layers upon layers of expertise and protection that an end investor is actually going to get through investing in one of these strategies.
I think that, so, I mean, I think we're up there in terms of thinking about the Fed interest rates, what have you. But I've been doing this a long time. Like, there are parts of fixed income, like picking where the 10 years is going to go. Like, we think it's going to be in a range. There are a million people who have a view on where the 10 years is going to go. And I think we'll get it right, hopefully more than most, but I'm not sure I'm certain we're not going to get it right all the time. But what we try and do is think through, gosh, I'm not going to make a huge bet on interest rates. The range of, like in Bank, we'll keep the range of our interest rate exposure from 2 years to 3.5 years of duration, maybe to get to 4 years. I would really believe in it. But I really believe this, that if you, and I've found this over the years in fixed income, I think we've measured this. If we get our calls right 65 to 70% of the time, there's no reason to try and outpick the market on the 10-year note. Like I said, we have some expression, but it's just not going to overwhelm the rest of the positioning. And I just think people are lying if they think, gosh, I've got a better view than the other million people, or that I'm going to be 95% right. It's just not going to, it just doesn't work. And so the idea being, if we can get 65 to 70% of all the markets right, just do it a billion times and don't try and like outpick the 10-year note, as your singular expression, or like I'm all in on high yield. Like, you never know what can happen. You can get geopolitical risk. So the idea being, just do it a bunch. Even as, like I said, really qualified in picking the 10-year note, it's a hard business.
Yeah, I hear you. I think our investors who are joining us today too, right? Like, this is a complicated subject. This is difficult to execute. That's why we have you here, providing some of that education. And as you mentioned, you run a range of strategies across BlackRock and around the world. But let's talk a little bit more about Bank specifically. So, flexible income ETF. What does that mean? What is that flexibility? What investors should want access to what you're doing specifically in this ETF?
I mean, the big thing that we're targeting is we're trying to be about 150 basis points over the index. So we use this multiverse. So the entire, what is the global index? So we try and run more yield, and we try and keep our income really high. I mean, we're pretty close to 7% today. Now, listen, if rates drop 50 basis points, I'm not going to take the risk and let's keep the yield at 7. It's just not, we're just not going to run it that way. Keep it at, get more yield than you can through an index. And then, keep your interest rate exposure in a reasonable range. I think the way the world has moved, like these indices, so you think about what a traditional index is in fixed income, the more the Treasury issues debt, the more it's in the index. The more you get high quality issuance agencies, et cetera, the more it's in an index. What we try and do is separate out the stuff. Like, why do you need to own a lot of 30-year Treasuries or any? They don't give you the yield and they're too volatile. Why do you own? There's a lot of debt that comes at very, very tight spreads, doesn't give you any incremental yield, and it hurts your liquidity. But the idea being, create what we think is the best assets to keep our yield up and keep our volatility down. We like high yield today, but in Europe, like, I don't want to take, growth is going to be slower. It's not that big a market, but I like double B high yield. In the US, I'm willing to take a little bit more risk. I'll take single B high yield. And then, I could take, and by the way, not triple C's. I don't think I have one triple C because, I think you'll see more defaults, as the economy moderates. So this idea being, what we think are the best assets in fixed income, and then keep your yield up. And, like at this point about, in a world that if you can get 7 and you can get that pretty close in good quality fixed income with low volatility. And I think there's some crazy stats that if you look at the drawdown, so the fund's been around for over a year now. When you get things where the index will trade down 5% or high yield, like I think our biggest drawdown was 190 basis points, so a third, a quarter, or a third of some of the other indices. So this idea they let people sleep at night while clipping income, By the way, not that we don't have, if rates went significantly higher, but generally it's going to be pretty darn stable.
And I think that's what a lot of our investors are looking for, right? How do you get that income? How do you get that stability? How do you get that diversification, from a world-class team and from a world-class, risk manager, which I think is really key to the strategy. You're being a little, I'm sorry.
Can I say one thing about, there's been, like, this is a pretty sexy time to get yield. And so what's happened is people have looked at what are the tools that I have. High yield has been a great tool. The high yield market's only $1.5 trillion market. U.S. Treasury issues 400 billion Treasury bills a week and 100 billion coupons a week. It's only $1.5 trillion market. But what's happened is everybody say, I want to buy, I need yield. I love this income. I want to buy high yield. So what's happened is it's created, high yield market that trades, much of the high yield market, double Bs, trade through investment grade credit. And then you have some triple Cs that are going to default. So what's happened is because of demand, its spreads are at historic tights in high yield. And so I just think if you got to parse it today and say, where's the value in high yield and where's it in US, where's the value in Europe? But, you create in this period of like getting income, they're just not, we talk about, REITs are interesting, a lot of leverage, some bank preferreds I like quite a bit, not that many, not that big a market, like more tools to get income, to create stability, that, have stability in your portfolio. I just think, and I think that's part of why, it's gotten so much attention and so much growth.
Yeah, and I think you were being modest. So around the 1 year anniversary of this strategy, of this ETF, it's in the $3 billion assets under management range, which is amazing because when we think about the growth of ETFs and active ETFs, that's a fairly unheard of growth rate for a strategy like this. And I think, everything you're talking about, the ability to capture that yield, the ability to have proper risk management, the ability to participate in some of the upside in duration, sort of as it emerges over time, is clearly incredibly attractive to investors. And I think that's why the strategy has grown so quickly. And index ETFs remain an incredibly important part of the market. But I think probably what's coming through here, I hope what's coming through to our listeners and to our investors today, is that there is a huge growth in active investing in fixed income because of the complexities, because of the sophistication required, and because, I love your term, in this golden age of fixed income, there really is an opportunity, if you're approaching the portfolio right, to capture that yield, to capture that growth, and to manage risk in a way that, honestly, investors haven't seen for really a generation.
I would say one thing if I could to that end. There,
yeah.
Many places, platforms before they put it on, like to see seasoning. And so, it's taken a while to get on some of the platforms. But like you said, that was a story. I think it was the fastest, I thought it said it was the fastest growing active ETF without even getting on those platforms yet. I think, and like I said, not because I have any wisdom, I think when you look across and people say, even periods where rates went higher or spreads widened out or pressure in the markets, if you look back and you see, well, how is this thing doing what it says on the tin? It's going to do what it says on the tin, and it's going to be consistent. And I think that's why people have really jumped on in terms of looking at this thing. And our commitment is not that we won't get the interest rate thing wrong at a given point in time, but just be consistent as you can be. And we've been doing it. Well, we've only been doing this for a year. I've been doing fixed income for most of my life now, and we've run these unconstrained funds. So I think many people on the call maybe invested. I run this Strategic Income Opportunities Fund. It's a huge fund. It's almost $40 billion fund, and we've been doing it for a really long time. It's gold medal rated, and been gold medal rated for a long time. And so we know how to manage unconstrained portfolios and look at different. So I think that's given people some comfort.
Yeah, and that growth rate being so incredible over such a short period of time, we watch the flows closely and excitedly in that strategy. And one of the things I think that's amazing about the opportunity to have you here today is you are a frequent contributor to media outlets all around the world, from CNBC to Bloomberg. And I think what's so amazing is when investors get to hear some of the amazing insights that we're getting to hear from you today as well, they're taking the opportunity, and we're actually seeing them, vote with their feet and move into a strategy like Bink, because they do find the opportunity and the insights so attractive there. And you mentioned, you mentioned a little bit about platform availability. I think one of the amazing things about Fidelity is the platform availability at the firm is so broad, meaning Bink is available. So BINC available to any Fidelity investor who's interested in it. And again, given its growth, given some of the sophistication that goes on there, something certainly worth considering, when you think about capturing income and all the reasons you'd be in fixed income at this time today.
It's a funny thing that, when you go on these shows, and invariably they just want to know, like, where do you think the 10 years going? Because usually it's, we want to buy stocks and we just want to make sure we're not going to get killed by the 10-year note. And it's such a funny thing because then, they usually ask a couple of questions like, where's the 10-year going? I just need to know, where's the 10-year going? And it's just, it is so ironic to how we think about fixed income. Like we have a view on the 10-year note, but it's like we're doing a billion other things. But I just find the media is, it's like everybody wants to do one thing at one time. And it's like laser focused on, so what you're telling me is it can't go over 4 3/4, because if it goes over 4 3/4, then the equity market's going down, then I got to get out. Which, by the way, I think is ridiculous to start with. Like, they said it like if the 10-year goes to 3%, oh my God, it's over 3.5, it's 4. I just think the equity market is much more similar to what we were talking about earlier. The interest rate tool is just these companies have termed out their debt. They're just not that sensitive anymore. But anyway, you get such a kick out of it because people like to pin, like, here's the number that equities will have a problem.
Yeah, and I love that you're willing to share that, right? Some commentators, that's the question they want to answer because that's the question that's being asked, right? But I think what you're telling the audience here is it's so much more complicated than that. There's so much more nuance than that, and I'm glad we're getting to discuss it today. I want to move over to the audience actually. So we've been receiving Q&A as we've been going through the subjects here, and excited to actually deliver to you some of the questions from our listeners. When we think about building a portfolio, income is one really critical part of that, and Bink can be a great solution for solving that problem. How else should investors be thinking about accessing, some of the great products out there, potentially from BlackRock, from iShares, that could also be important parts of a fixed income portfolio?
So the first thing I will say, and then, it's my opinion, and others have different opinions on this. Traditionally, when people thought about their portfolios, it was 60-40, and like, I know what it's going to do. Like, I'm in equities and at 40% because I got to buy the index. Listen, I still think you should own some long interest rate exposure. If the world, if there's some big geopolitical shock, it will help. I just think that paradigm, though, of 60-40, and I've done what I need to do, I just don't think is right anymore. And so what I think today is income is, so if you think about you built a portfolio, I still like equities, but what is happening in your equity portfolio? You're much more, almost definitionally, more in tech, more in a more concentrated equity portfolio, just by literally just sitting there. It just has become more beta focused, volatility focused. So I'm thinking about, okay, I've got an equity portfolio that's, I think will keep doing its job. And companies today throw off 18-19% return on equity. That is amazing. And so the book value, your equity is going higher, and then they buy back a bunch of stocks. So if I'm comfortable or I'm going to own some portion of that, what else do I do? Part of why we like Bink is, get income, create stability. That is if you clip yield and income, that is a better hedge than, so think about if inflation is higher, and I tracked this, 12 out of the last 12 inflation reports, 12 and the last 12 that were off expectations, meaning not right on the screws what people thought. The equity market and the long end of the interest rate curve did exactly the same thing, meaning rates went higher when equities went down. So meaning it's not a hedge. It is, so think about things differently. Use income as a hedge. I will say one thing about mutual funds. I run these unconstrained mutual funds. We do some different things in the mutual funds because now more private financing allows us to do things that are really creative and, we're funding, like, the world's terrified about commercial real estate today, but it's office that is a problem. But there are things like logistics, warehouse, hospitality, multifamily that you're actually getting some really good opportunities. So today, in some of the mutual funds as well, where you get some access to that, and then private credit is also something I think is really, really interesting today because bank financing is restricted today. Like almost every day, Jeff, every day we're having an investment committee meeting on some financing in real estate or private credit. that is really interesting. So being able to access that through some mutual funds as well can be super attractive to people today.
So Rick, I've known you for 10, 11 years now. This audience maybe has only known you for 45 minutes or so as we've been going. But as I'm reading some of the questions, and if I started to sort of coalesce some of them, there's a lot of interest in your view on just major trends in the world. And I know you have a lot of views on those subjects. And maybe to help sort of focus some of these audience questions, I'll allude back to two of the things you talked about. And at BlackRock, we have our mega forces, right? These massive seismic transformations that are driving change globally. One of the things we talked about up front was aging populations and what that means for the economy right now. But I know you also think about this in a much broader context beyond the United States over the next 10, 20 years, across fixed income, equities, the way they live their lives. What should investors here know about your views on those major trends in demographics?
So can I say one that's near term, that maybe not as much demographic, but and then in 2024, 80% of the market capitalization of the world is going to have an election. 60% of GDP in the world is going to have an election. 40% of I think it's 45% of the people in the world will be voting. Wow, like there's going to be some volatility in, you think about, we've had elections in France, Mexico, UK. I mean, there is. So anyway, part of what we think about from an investment point of view, particularly going in the second half of the year, and we have a debate tonight, and the world's going to thinking exactly where you're going to be. Like France has gone through this tumult. So you got to be I've learned over my career, particularly in emerging markets, like political change, that's the whole gig in many places. So anyway, that to me is one thing we got to watch. And, I'll say, let me start with the US. Whoever wins the debate, I'm not going to make a political statement, but whoever wins the debate, the one thing I worry about is nobody seems to be running on let's cut the debt in this country. It's who's going to cut taxes more? One's going to cut taxes more, the other may spend more. I think we got to be really careful about long end interest rates. And so that's something to me in the US, we got to be a little bit careful about that because I can create some volatility in our portfolios. Second is the world is shifting demographically and economically. So where do you want to be an equity investor and where do you want to be a lender? I already talked about Europe. Europe, the demographics are terrible. Italy, Germany, they're terrible. And they regulate and they don't have enough innovation technology. I don't mean to be disparate. I mean, there are parts of Europe that are very exciting. But I like being a lender there. They're going to grow slowly. They got to get rates down. You don't create enough velocity in Europe unless you get rates. Think about it. We used to lend companies money at negative. Remember that? I told my kids, I was lending. Remember the company Nestle's? We were lending them at negative 1%. Like that. Why would you ever pay a company to take their money? I don't know. It's stupid. But anyway, now they got to cut rates. So anyway, I like being a lender in Europe. India is the most extraordinary demographic story I've ever seen. I was just there. They're transforming that whole economy to a digital economy. Innovation is extraordinary. Equities are hard in India because the big companies trade at a very high valuation. There's only a few of them, but I would buy Indian equities, and we do it in our portfolios. Buy equities, and I put them away for even though the valuation is maybe a bit full. Japan is going through a renaissance in two ways. One, you have durable inflation. You actually now, because of women in the workforce, you actually create, real wage pressure at times, and you have a much more vibrant economy. And secondly, the investment that used to go into China has moved, or is moving. And there's some exciting stories in automation, biotech, et cetera, in Japan. So I think Japan's interesting. And then I think the demographic in China is really tough. And I think from an investment point of view, it is challenged today. We think the economy's fine, but who knows from the political, what have you. So we've been orienting where we are in the world, be more aggressive around your equity, go bottom of the cap stack, Japan, India, US, lend more in Europe, and and then be selective in parts of EM. But I still like higher quality EM. Today, and like we talk about Mexico, Brazil, Indonesia, but even there, you got to be a bit careful because you get political change.
And just to make a point for the audience, because it's actually such an intuitive way to think about things, we don't always talk about it this way. Effectively, what you're doing when you're buying a bond is you're the lender, right? You are the one who is actually lending money. And that's such an important way to conceptualize, but a lot of investors don't necessarily think about it that way, right? They think about, oh, I buy this, I receive an income stream, as opposed to actually I've lent money to someone, to an organization, to a government, and what I'm getting back for that is this income stream.
Jeff, what's pretty incredible around that? Like I grew up as a commercial, and I started my career as a commercial lender at a big commercial bank. And it was always the case, if you lent money for people for longer periods of time, you got paid more for it. Today, this is part of why it's nirvana. It's like the curve is inverted. Like I why not just sit in 3-year paper or 3-year and 5-year investing? You're like, why do I need to go out the yield curve? And it's just, as much as I've been doing it for a long time, you break it down and think about what are we actually doing? We're lending. And if we are lending, like, boy, if I don't need to have that wag of volatility, like, why take it?
Yep. Let me ask you one last question, which I think also we've alluded to, and staying on these sort of big trends or mega forces. I don't know if you think of yourself this way, but having heard you speak on these subjects, I certainly think of you as a bit of a futurist. So demographics is one of the things you've thought a lot about. We talked about some of the areas of impact on portfolios, but you also in there started to talk a bit about technological change and artificial intelligence being one of those. How is that affecting your view of the world and investing today?
That's my favorite subject. So if I can say this, so I know I've gotten to know people like Elon Musk over the years, and I've visited and I got his recently, and I think people underestimate what's happening in AI is extraordinary. The amount of investment is going to go and how it's going to change the world. But things like robotics, I mean, if you go on Tesla's website and you look at the robots, I got to see these robots. Oh my God! Like the world is going to. We've never had. Think about what these robots used to be able to do. And I've asked people about, including at Tesla. It used to be you pick up a part, you move it to another, and you do it over and over and to another place, and you do it over and over again. Now that automation allows you to make a cognitive decision. So now the car can pick up somebody from the airport and make a decision. Like there's a lot of frenzy in the airport, but it can make a decision better than a human can. Wow! Like that is. I mean, as simple as it is, it's extraordinary about what it means for productivity, what it means for, inflation. You could have this investment in inflation, in CapEx, data centers, energy, cooling, et cetera. So you lead to a higher level of inflation, but then we're going to get to the other side of the wall, which will be productivity enhancement. What does it mean for wages? And I think the world, quite frankly, it's the most exciting time in investing ever, because you're trying to think through, what you call it, operating in the haze. Today, innovation, automation, and by the way, I'll throw out one thing that I learned from Sam Altman is, I was a huge honor to do an interview with him, and he said something I thought was brilliant. He said, augmentation is going to happen much faster than automation, meaning you're going to see enhancing of processes. And you spend a lot of money today to build until you get a process that's going to get you to the other side. But today we think it's going to augment. So we do it with research and portfolio construction and analytics. But we're in an era today, and it'd be interesting to see when do we go to the other side. But there's some companies in automation, in software, in cloud that are really, really interesting today that to think about. Everybody knows NVIDIA. But what is the next iteration? And I think there's some really interesting investments alongside of that.
Your passion came through loud and clear there. And, I think everyone knows the name of the first gentleman you mentioned, but Sam Altman, for the group, maybe not as well known a name, but runs OpenAI, which is the creator of a program many people on here have probably used, a little program called ChatGPT. So, maybe to bring it all together, Rick, and thank you again so much for doing this today, right? Bond investing as a general matter can be a tricky thing for the individual to do. And what you and your team are bringing to folks here with BINC, BINC, is an opportunity to own a wide range of bonds across a range of different parts of the bond markets, run by one of the leading fixed income investors, a team of almost 500 folks, and then proper risk management and controls around that in an easily traded liquid structure of the ETF. But even more than that, you get an investor who's thinking about these big changes in the world, in demographics, who's as excited as you are about some of the transformations in artificial intelligence and automation. And I think a lot of that really explains why active ETFs have been the fastest growing part of the active ETF market. And I can certainly understand, hopefully our audience can as well, understand listening to you why BINC is one of the fastest growing active ETFs of all time.
Thanks.
So thank you. Thank you so much. I'm sorry, Rick, do you want to close with the last word there?
I'll say one last thing. So I've gotten a chance on podcasts to interview the smartest investors in the world. And it's such a funny thing when you ask them, what do you think? And they always sort of, I don't know, I don't know. But then if you ask somebody who doesn't manage money, like they give you the most clear, like, this is what's going to happen. And the truth is, the reason why those people are great investors, not that I am, but hopefully we work really hard at it. What makes those people good investors is like they're taking losses. And they like stuff happens and they see. So, but what you try and do, I think what I've learned from a lot of those people over the years is you got to think about, like, I got to stay in a corridor. When I think I'm right, I got to make sure I'm higher in that. And then I got to get out when I think I've made a bad decision. And I just think if you can do that a million times and try and think through, the world does some crazy things, but just try and create consistency. And when you think you're on the right trend, make sure you're taking advantage of it. And I've learned a bunch from them, from a lot of those people on, and I think, we try and employ that in our funds, in our, in a bank, to just try and keep it. Don't think you're the smartest in the universe. Have some humility in what you're doing and just try and, create consistency.
And I think that is an amazing place for us to pass back, just on sort of the words of wisdom of the importance of humility to the investor, which I couldn't agree more, is absolutely critical. We've heard yours. I think we've also heard your insights and sophistication. And so, Don, with that, let me pass it back to you. And thank you so much for having us from BlackRock join you today.
It's our pleasure. Thank you, Jeff. Thank you, Rick. I know personally I enjoyed listening to the two of you. Great insights, lots to think about. Rick, I agree with what you shared there at the end. That's why we plan, and that's why investors at Fidelity work with Fidelity to plan. I'm coming to you from the Burlington Center today. You always feel welcome to work with your local office and meet with your advisors to build a plan and a strategy that's right for you as an investor. For all of our investors that are here today, thank you for spending time with us. This was our second of 3 sessions. There'll be a third session after this in just a few minutes. You'll get a survey under the video. So if you have a chance, we'd love to hear how we're doing. You'll also be getting an email later today. If you have a chance to look at that, please open it because it will give you additional learning opportunities. When we think about what we've done so far today, we learned about ETFs in our first session. We got great insights from Jeff and Rick in our second session here on fixed income. And now we have Mike Keating coming up next, who's going to talk to us a little bit about putting some of this to work. So we look forward to seeing you again soon. Thank you, everyone.
Yeah, Don, thank you. Really appreciate you having us, first and foremost. It's good to be here. And just a little background on myself. I've been with BlackRock now over 16 years. Prior to being at BlackRock, I was a Fidelity financial consultant for 9 years. But my entire career here at BlackRock has been solely focused on our ETF franchise, which is iShares. And part of my role is partnering with people like you, Don, and educating on the pros of ETFs, the ETF industry in general, and just giving more talking points around the way investors can begin to use ETFs or really implement ETFs within their portfolios. So again, looking forward to the next this session, Don. Thank you so much for having me.
Great to have you, Mike. I know we've done a lot of these before, so I'm excited to be back with you. When we think about today and we think about helping our clients, if you joined us for the previous 2 sessions, we spent a lot of time talking about what ETFs are. Bob provided some great examples. The previous session 2, we had a deep dive into the fixed income space and some great insights by Jeff and Rick. Mike, today we're going to go through and take a look at really how to get started. We have some great examples in the slide to talk to and give you some more talking points. And then we did schedule a lot of today's presentation to get into the website, get into different ways to do your own research, implement strategies, monitor strategies, and of course, most importantly, answer any questions that you might have for us today. So let's jump into it, Mike, and get started. If we can move over to the next slide here. Mike, I know we spent time on this in session one, but we always like to revisit it. Talk to me just at a high level, what I'm thinking about an ETF, what are the important things to know?
Yeah, Don, I think it's all about diversification first and foremost. I think, the value of what an ETF is really and what it stands for is exchange traded fund. I know a lot of people know that term already, but ETFs are simply just a basket of either individual stocks or bonds that's packaged together and offered on the stock exchange. So the cool thing about ETFs is that investors are able to actually trade intraday, which is a little bit different than a traditional mutual fund, as we all know, which is once per day. So again, an ETF is offered on the exchange. It's a diversified basket of either stocks or bonds. It allows you to buy and sell throughout the day if you wanted to.
Mike, some of the other talking points that were mentioned earlier as we talked about ETFs, cost. I don't know if you have any talking points you want to mention around cost and how that affects, investors as we're looking for different types of funds and maybe things to consider as we're looking at cost.
Yeah, I mean, I think if you go forward to the next slide, I think this is a really good visual in terms of, and I'm going to skip ahead a little bit, but the growth, right, Don? I think it's all about really where we're seeing the growth within kind of the ETF industry, but really what it's all coming from. And a lot of people ask, well, you're seeing this tremendous growth, right? You're seeing this year over year, trillions of dollars flowing into the ETF market. We're now seeing traditional mutual funds, right, Don, converting to an ETF structure. And a lot of investors say, well, why is that? What's the value to an ETF? And I think it's several things, but I think that the two main points, and going back to the earlier slide, Jalen, thank you, is one, it's tax efficiency. So ETFs, the structure of an ETF is a little bit different than the structure of a mutual fund. So ETFs just tend to be more tax efficient from a capital gain distribution perspective than they are versus actively managed mutual funds. So if you see here, Don, on the left-hand side, the amount of mutual funds over the last 5 years that have kicked out a capital gain distribution versus overall ETFs, which is 7%. So you go from 53% to 7%, and then highlighting the value of really iShares, who I represent. We are the world's largest ETF provider. 0% of our iShares style box ETFs have kicked out a capital gain distribution at the end of the year. So I think this is really important. But on the right-hand side then, Don, you get into the costs, right? And how ETFs are simply lower in cost than many other investments out there. So you have two things here. I think what I would focus on is investors that are investing, right? What can you control within your portfolio? And a lot of that has to do with the cost that you're paying for the underlying investment, and can you own a more tax efficient vehicle in a specific area of your portfolio. So I think this has been an area where we've seen that tremendous growth, not only the low cost, but also the simple tax efficiency of the ETF structure.
Mike, without getting into all the fine print of in-kind creation redemption, I know the question that always comes up is, how can an ETF do that? I don't know if you have a few talking points you want to provide.
Yeah, and John, I know you love to add on to this as well as we do our seminars, but it's simple as this, right? ETFs have been around for over 30 years now. The majority of ETFs are index based, right? So they track a specific index. Think about very simply, large cap like S&P 500, right? We have IVV, which is an ETF through iShares that tracks the S&P 500. So first and foremost, in tax efficiency, right? Less turnover, Don, right? Less turnover within the underlying fund. But secondly, what makes an ETF different from a mutual fund, like we said before, is the fact that it trades on the stock exchange. So Don, if you're an investor, right, and you own an ETF and you want to sell that ETF, how are you going to do that?
Going to go to fidelity.com, Mike, and I'm going to do my research. I'm going to go to our trade ticket, and then importantly, understand how equity order types work and make sure I place the right order for me.
So you're going to place the order, right? And where does that order go?
That order is going to go to Fidelity, Mike.
Yep. And then, so basically you want to sell that ETF. I'm a buyer, so I want to buy that same security. So basically what happens is similar to an individual stock, right, Don? There's going to be buyers and sellers. So basically you're just selling your shares to a buyer like myself, and I'm buying those shares on the stock exchange from you. So basically what that means is there's less cash transactions, right? Where we don't have to sell the underlying holdings, which is what a mutual fund has to do at 4:00 every day. That mutual fund has to meet supply and demand, right? So the mutual fund manager has to either sell or buy those specific underlying stocks, which could create tax consequences, which the mutual fund has to distribute at the end of the year. So that's kind of how the differences between the ETF and the mutual fund structure, and why ETFs tend to be simply more tax efficient than mutual funds.
I think that's super helpful, Mike. Thank you for clarifying and sharing. I know that's always, I miss the days of working in person with big events as much as I enjoy being with you on Zoom. But that's always the question we get. So I'm glad we got a chance to clarify that. I wrote down and I took notes, and I would encourage everyone to take notes here today too. As we get to the platform, as we get to the Fidelity site, if we look at some examples, Mike, we'll take a look at where investors can do this research on their own to see what the distribution history of any fund might look like.
Yeah, and Don, just to real quick add to the left-hand side of this, we as a firm and BlackRock, right? We have relationships with many different providers, right? Custodial platforms, things like that. And something we've seen for a long time now is investors now are implementing kind of that third tiers, that third column within their portfolio, which is basically tax efficiency. So not only are you looking to generate returns within your portfolio, but now we're seeing this keen focus on what we call adding tax alpha to a portfolio. And so what we say with that is, as you can see on the left-hand side, there's a lot of tax inefficient investments out there. So can you find a more tax efficient investment within your portfolio? And taxes have a huge drag on portfolios. If you think about over the last 5 years, mutual fund portfolios have over a 2% tax drag on their portfolio. So thinking about that, and this is why I say things that you can control within your portfolio, which is costs, and adding kind of that more tax efficient exposure within your overall portfolio. And this isn't to say mutual funds are bad across the board, obviously. Obviously, Fidelity's got a huge mutual fund business, BlackRock, the same thing. But there are a lot of mutual funds out there, Don, that are charging pretty high fees, and they're very tax inefficient. So just be cognizant of that. And a lot of times there's an ETF that can fill that part of your portfolio.
Yeah, absolutely, Mike. That's a great point. That's why sometimes you'll hear, as you work with your local Fidelity advisor, not only know what you own, but know where you own it, and be tactical with your strategy to make sure that you're getting the most out of your portfolio. Why don't we move on to the next slide, Mike, if we can?
Yeah, and just to add to this slide here, Don, like you said, I mean, the amazing growth, right? And I've said this before, the ETF industry, and I've been saying this now for 10 years, right? Has become the fastest growing segment of the asset management industry. Okay, so what we're currently seeing in terms of flows or money moving into ETFs, last year, just under $1 trillion, Don, flowed into the ETF market. So buyers coming into the market. This year, end of June, we're already up to over $600 billion that has flowed into ETFs year to date. So this year, we're more than 2 times the pace, versus where we were last year. So there's now over 13 trillion, Don, that sits in ETFs across the globe. And most of that continues to go into these very broad flagship core building blocks of a portfolio like S&P 500, IVV, which is iShares. So, it's a pretty amazing growth within the industry. And a lot of that simply has to do, Don, with low cost and tax efficiency and diversification. And then lastly on that, as you can see, the 50% there, I like to point this out because everyone said, well, where's the growth coming from? Who is buying ETFs? Well, now one of the fastest growing segments of users have actually become individual investors. So these are the investors that are actually on this webinar today, have become one of the fastest growing segments. And this is just kind of a little kind of nutshell here. 5 of the 10 most purchased securities by individual investors were ETFs between Q1 2023 and Q3 2023. So pretty significant. And again, I think it hits home with the audience that's actually on this webinar today.
It is a good point. I think most of us know that ETFs have been around a while, but I don't know if we knew that ETFs have been around as long as they have. And as much as quick as the space is growing, it's not just necessarily new dollars into existing funds, but new types of funds becoming available for investors, which we'll talk about. Let's move on to the next slide where we can start to actually talk about that and think about some different types of ideas, Mike. If I'm an investor and I'm looking to either build a portfolio or complement a portfolio, if you want to, share some of the talking points we have here. And before I hand it over to you, Mike, I took a note to remind myself that I always get asked the question, where can I get the slides after the presentation? So remember, if you go below the video viewer, you should see a link to download the slides. So you don't have to feel like you have to note every one of these tickers down, but instead we can hear a little bit about what Mike has to say about a few of them here.
Yeah, and Don, another thing to mention that I failed to mention earlier is that we're actually hosting a follow-up session to this event tomorrow at 10:30 Eastern time. So that will be with the Fidelity strategy desk. So if anyone wants to join that, feel free to join. I think you can just do that right through fidelity.com. But I think that this is a very telling slide. And I love every one of these ETFs because, Don, when I mentioned flagship, this is what it is right here, right? So this is, again, the core, right? Core building blocks of a portfolio. These are the low cost, right? The tax efficient, the very liquid ETFs that have a lot of trading volume where you're getting very tight kind of bid-ask spreads when you're buying them. But just some notable themes here. And I mentioned IVV earlier. IVV is a iShare ETF that tracks the S&P 500. So basically, we're managing that ETF to track that specific benchmark over time. Think about this, Don. 3 basis points, so 0.03% to own this ETF. So again, talk about the low cost nature of ETFs. Talk about just gaining exposure to a specific benchmark like the S&P 500. The other one I want to mention is the one on the right-hand side, ITOT. So ITOT is another ETF. It's been around for over 15 years. It's an iShare ETF that basically is giving investors access to the total U.S. stock market, Don. So this is giving you access to large cap, mid cap, small cap. This ETF actually holds over 2,500 individual securities, Don. So you talk about diversification, right? So this is a portfolio that's giving you access to the total market for 3 basis points or 0.03% expense ratio. So extremely low cost, but it's also giving you that instant diversification and allowing investors just to gain access to kind of all the different style boxes, large cap, mid cap, and small cap, Don. So this is one of those ETFs we talk about often, and I know you've talked to investors about this. If they are very hands-off, right? They don't want to do a lot in terms of research and having to build a specific portfolio using large cap, mid cap, small cap, different positions. They can simply plug into an ITOT and get that exposure where you're getting that diversified instant access to the U.S. market. So I always like to mention that as a very kind of broad index, but extremely low cost and diversified.
So Mike, why would an investor want to buy IVV, IJH, IJR, if they can get it all in one, why would someone consider buying the three separately?
Well, I would bet, Don, that you're one of the people that would buy the left side,
Huh.
right? IVV, IJH, and IJR, because you like to be involved with your portfolio, right? You like to do research. You know the markets. So I think investors that are at that level will enjoy the fact that they can dial up or dial down their large cap exposure, or dial up or dial down their mid cap or small cap exposure, right? So depending on the market conditions, it allows investors to be more hands-on, right? And really just adjust their portfolio, rebalance, and increasing or decreasing their exposure to all these different size areas of their portfolio. So I think that's where I would say it's more hands-on versus the ITOT in one is just kind of those investors that don't want to have to do all that research and just simply plug into the one ETF.
As we're thinking about building a portfolio, Mike, there's a lot of examples here. One of the things that we're missing that I'm going to note down that we can talk about as we get to the Fidelity website is how much of each? What is the right allocation? It's worth noting that you can meet with any of your Fidelity advisors and talk through what's the right, how much of each for you, what's the right asset allocation for you. And then if you are looking for ideas, if you are looking for what does a balanced portfolio look like? What does an aggressive portfolio look like? What does growth with income look like? We have a portfolio builder on fidelity.com that will help you decide how much of each as you start to consider building a portfolio, or maybe taking just some of these to complement what you already have.
And Don, I have a question for you. How many ETFs here in the US are available on the stock exchange?
A lot. It's growing every time I look. I would think it's somewhere in the 3,000 range.
Yeah, so that's the point. Yep, right around there. But here's the thing. As you look at this slide here, right, we talked about the left-hand side, broad-based equity. These ETFs have been around for a long time. Again, these ETFs are broad-based, they're very low cost. But then you get into the more niche areas, right, where it says specialty. And I love this, talking about this, because this is the true value of the ETF market, is that they give you pinpoint exposure to certain areas of the market, depending on you as an investor and what you want to gain access to. We talk to a lot of investors that already have portfolios built, right, Don? But they want to somehow start to implement ETFs in their portfolios. And I think on the right-hand side, that's where many investors, especially under specialty, this is one of the big areas of ETF investing are income generating ETFs or dividend paying ETFs right here. So there's many different flavors here, but these specific ETFs will actually pay investors dividends, and just like individual stocks. So I always, you've heard this whenever we do these in person, we always say, just by a show of hands, how many of you in this room own dividend paying stocks, right, Don? You get a bunch of people raise their hand, and then you kind of ask the follow-up question, why do you own individual dividend paying stocks, right? And many of them will just say, well, it pays me an income. It's given me over 4%. So then we ask the follow-up question, are you comfortable with those individual dividend paying stocks? Are you comfortable with that individual company risk? And many clients say, well, what other way can you do it? And here it is right here. You can do this. And this is the true growth of the ETF market, is the fact that now, or this has been around for a while, you can buy or you can generate income in your portfolio through ETFs. These ETFs here, DGRO, we call it DGRO, Don. This is an ETF that is buying only dividend growing stocks. So the stocks have to fit into that dividend growth category, and that's specifically what it holds. There's other dividend paying ETFs, but this is the really cool thing about ETFs, is that you have all these different flavors and allows investors to really truly build out that type of portfolio.
I think it's neat that you can see all the way on the left how low these expense ratios are. And then as we find our way over to the right a little bit, you're adding in something like a dividend growth strategy, but only adding in a few basis points of cost. For an investor to build a portfolio diversified of dividend growing stocks, it would take a lot of ongoing research to monitor the dividend growth rate of the stock, it would take a lot of research to monitor the payout ratio, and other characteristics that are important. So we'll take a look at this as an example as we move on. Mike, any other talking points on this page you want to provide before we move on to the next page?
No, I would just say on the right, obviously international investments. So you can gain, and Don, you're talking about cost. I mean, you talk about, gaining access to international markets for a very low cost. Again, 0.07%. So, again, ETFs, the different choices that you have, the amount of ETFs that are available, but it truly allows investors to build out portfolios, to pinpoint certain areas of their portfolio.
Mike, one of the questions that came in before we leave this page, if you can, you mentioned style box. Can you just tell us quickly what you mean when you say style box?
Yeah. So, and I'm going to put this back on you again, Don, after I answer this, but, building out a portfolio, right? I mean, modern portfolio theory, right? When you're building out portfolios, you want to gain access to a diversified portfolio through many different types of stocks, right? And that could be large cap stocks, mid cap stocks, right? Small cap stocks, but even large cap growth, large cap value. So you have all those kind of boxes, and that's what we call style boxes. So large cap growth would fall into the top right? Large cap value, top left. But in a portfolio, we believe that those are kind of the building blocks of a well-diversified portfolio for a long-term investor.
Thank you, Mike. It's worth noting, and I will point this out, that you can see the style box of a fund on the Fidelity site. So if we wanted to see a category that a fund falls within, and we can also see a style box of an account or a portfolio that you might have. And what we mean by that is, as different investments are getting characterized based off of the way that the companies run, does the company take its earnings and reinvest in the company? Does the company take its earnings and pay out more to its shareholders through a dividend? It gets categorized. And then from there, we can see the way that your companies that are in your portfolio are built or made up together. And then, of course, the other half of the style map that we can see too is, are you invested in all large companies or small companies, or what's the mix look like? As that'll play a role in the volatility and the risk profile of your account too. I'll make sure that I note that down, that we take a look at that, Mike, if we want to move on to the next page.
Yeah, and this is, just to kind of set it up, Don, I mean, again, questions that we receive, or a lot of conversations that we have with individual investors or advisors and things like that are, where are you seeing the flows, right? Or where are you seeing the themes within the ETF market? Where's the money going in a lot of cases? And, more of the broad-based exposure. So, we just wanted to highlight some areas for investors, that where they can potentially look to gain exposure to ETFs. So if you look at the next slide, what you'll see is two ETFs that I would highlight here. And what I'm going to go through here are different themes, right? And this first one, what we talk about, Don, is what we say, putting cash to work. Now, Don, what does that mean to you?
It could mean a lot of different things, but what it means to me, Mike, is my cash is sitting there idle and it's earning me what it's earning me. I have not a lot of control over that. So if I want to put my cash to work, I could either invest it in the market and risk it. I could put it into, a more conservative asset like a bond, to try and get more. So there's a lot of different ways that what that means to me. But I can see here, you're pointing out a couple of funds that, from what it sounds like, are maybe giving me a little bit of yield, but without taking on a lot of risk to try and get a little bit more than what cash is giving me. What do you have on these two?
Exactly.
What do you want to share with us?
Doc, so this is where it is, right? We're still sitting on, I think it's roughly $6 trillion in assets sitting in money markets, right? Sitting on the sidelines, what we would always say, right? Now, some of that money should be on the sidelines, but a lot of that cash is investors that just kind of don't know what to do really right now, right? We're still at this, we're still at this kind of hold with interest rates, right? Is the Fed going to ease at some point? What are the minutes looking at? What's the number of rate decreases we're going to see next year? Things like that. So a lot of people are just kind of confused. And what I would always say about that is like, take the time, if you do have a Fidelity, representative, a financial consultant, take the time to meet with them. I think they could do a lot for you, but, just giving you more, direction. But Don, here's what it is. People are sitting in cash and we're still at this holding period where the Fed is holding out on potentially lowering rates, right? So they've raised rates over the last 2 years. Now we're kind of at this holding place. People are getting pretty good rates in their money markets, right, Don? I mean, what's a Fidelity money market paying now? Over 5%, right? In the taxable. So it's, but what people are starting to realize at some point, the Fed is going to lower rates. So some people are saying this might be a good time to potentially step out of cash and possibly move into something that has a little more upside potential. And what we look at here are these two ETFs right here is what we call ultra short duration fixed income ETFs. Okay, so this is where we've seen investors use these. Again, you're still going to have some fluctuation. You're going to take some risk, but taking that step out of cash and potentially getting into something as the Fed starts to lower rates could potentially be, a good area of investing. So it's fixed income. The first one is what we call SGOV, Don. SGOV is a ticker. This is an ETF that is investing solely in treasury bonds that mature anywhere up to 3 months. So 3 months or less of maturities. So you're taking that step out of cash. You're getting a 30-day SEC yield over 5%. Okay. But you're getting into something that has a little more potential if the Fed does start at some point to lower rates. So that's SGOV. And just Don, just to give you a view to the fluctuations over the last 52 weeks, and a lot of this you'd be able to see if you bring it up on our website. The 52-week range is basically from a price perspective of the underlying ETF is $100 even to $100.75. That is the 52-week fluctuation or range in price. So I think it gives you a pretty good idea of if you were to step out of cash and gain exposure to something like this, the volatility that you would be exposed to. The next one that we see, is something that we call iCash, Don, ICSH. It's a little bit different. It's still ultra short duration. It's still an ETF where, people use it to take a step out of cash to gain exposure to more fixed income. But this is one of our actively managed ultra short duration ETFs that's basically investing in a wide variety of very short-term bonds. So it's not just exposed to treasury bonds. You have exposure to to corporate bonds. You have exposure to treasury. So it's across the board. There's many different types of bonds that it holds. It's giving an SEC yield of over 5%. It's 8 basis points, and I didn't mention SGOV is 7 basis points, so 0.07%. iCash or ICSH is 0.08%. And the range on that, Don, also in terms of the price range, in the last 52 weeks, it's ranged from $50.11 to $50.61. So that's the price range over the last 52 weeks. I like to kind of mention that because a lot of people say, all right, well, I am moving out of cash, which is basically it doesn't fluctuate. You're moving into something that does fluctuate. So just to give you a look into the actual fluctuations over the last year.
That's helpful, Mike. We'll take a look at that too as we go to the site. So far, you've shared with us some ideas for funds to solve for different asset classes. Now we're looking at funds for solving for putting cash to work. What else do you have for us?
Yeah, so taking a little more exposure, down a little more risk, obviously. This is for clients that what we say pursue consistent income. So these are ETFs that we believe have a longer term hold in portfolios. The one I wanted to mention on the left-hand side is HDV. This is one of our flagship dividend equity ETF. So this is an ETF that's owning individual stocks of all dividend-paying companies. But what's a little bit different, Don, between this ETF, HDV, and the one we highlighted before, which was DGRO or DGRO. DGRO, which we talked about before, owns only dividend growers, right? So that fund, the rule on that fund is it can only buy dividend growth stocks. This one, HDV, is a little bit different. It's a little bit different style, little different flavor, where it's something that we call high dividend. So they're looking at these rules, the rules within the ETF. It has to fall into a very concentrated portfolio of 75 high quality US dividend paying companies. So think on top 10 like Johnson & Johnson, Verizon, kind of those bellwether companies. That's what HDV is. So what we call high dividend, wide moat stocks, financial health. So very kind of large cap quality type income generating ETF through HDV. And Don, this actually pays out quarterly. So it pays out a quarterly dividend to investors.
It's a big difference there to think about. And you can see the importance of, doing your homework, which we have available, and great information that you're sharing with us here, Mike. If you're in a dividend growth fund, you're getting the growth of the dividend. But what are you potentially missing out on that a fund that's paying a great dividend, but just not growing it at the same pace might be? So, how does it kind of fit into the investment need that you're trying to solve for? And then obviously the fund over here on the right is the fund that was talked about in the previous session with Rick and his team.
Yeah, so Rick Reeder, obviously Morningstar portfolio manager of the year last year. We were really glad when BlackRock said we're going to launch a ETF and have Rick Reeder actually manage it. So we were pretty excited about that, Don. And as was discussed in the earlier session, the fastest growing actively managed ETF, was launched a little over a year ago now, but it's an active strategy, Don. It's looking to generate high income. It's investing in a wide array of fixed income securities, and it allows Rick and his team to be very active in terms of how they're looking to allocate the capital in terms of driving that income, but also driving that in a way where they're accessing all different areas of the bond market. And that's an ETF currently yielding just under 6%.
I noted that down too, Mike. We'll scroll through and look through a few more of these. What's up next here on the next slide for us, Mike?
Yeah, and Don, we love talking about this as well, right? So on the left-hand side, do it yourself. So again, kind of piggybacking on what we discussed before with ITOT, Don, there's a very simple way to build a very low-cost, tax-efficient portfolio. So this is what we talk about, right? Asset allocation. You want to have some sort of exposure to equities, some sort of exposure to bonds. This on the left-hand side is what we call a kind of a balanced portfolio, Don, a 60-40 split between stocks, using 60% of that in ITOT, and the rest of 40% in flagship ETF through iShares, which is AGG. So it's tracking the aggregate bond index. Don, look at the expense ratios. Again, 0.03%. You're gaining exposure here. Think about this. AGG has over 10,000 holdings, 10,000 bonds, over 10,000 bonds that are sitting in that portfolio. So you talk about diversification in one trade, you have it there. And then you have ITOT, where you're gaining exposure to that over 2,500 individual stocks through one trade. So very low cost, tax efficient, diversified portfolio there.
Mike, sometimes when I work with investors, I'm asked about allocation funds, kind of like what we're seeing in the all-in-one here on the right with AOR. But a lot of the allocation funds I'm asked about kind of have a target date where it starts at 60-40, but it ends at something else. What's the goal of this fund? Mike, I'm not hearing you. If you want to maybe mute or unmute your microphone here. And give it one more try when you unmute here, Mike. I'll let you work on that. And while you work on that, and I'll tell you when I hear you again, some of the things that I'm thinking about when I see this, the all-in-one or the AOR, and I love how creative these tickers are with the names. You can see that this is giving you a simple solution, one trade 60-40. If I go to the left, now I have two funds to get to the 60-40. Why would I want to buy the two instead of the one? Well, the reason you'd want to buy the two instead of the one, if you were considering, is because you'd be more hands-on in that example. What you need to do in order to stay at 60-40 is you'd need to have some type of strategy to come in and monitor and rebalance. The fund on the right is doing that for you. The fund on the left, you're going to be responsible for staying at whatever percentage you want to stay at, or maybe not being 60-40, maybe say 70-30 or 80-20 or 50-50, whatever number's right for you. If we went back a few slides, I'm not asking to go back a few slides, but if we did, we saw where we could do, instead of ITOT, we could do IVV, IJH, IJR to build an ITOT. And now from within there, we can either rebalance those three or change the mixes there too. And then furthest to the right is where you're starting to see the ETF portfolio builder tool. The ETF portfolio builder tool is going to give us the ability to be even more hands-on, where we can have a list of more funds. And from there, we can pick and choose which funds do we want and at what percentages. Mike, while you work on your microphone, and that's fine, this is a good segue where I'm going to take us to the Fidelity website, and I'm going to start to go through some of the tools and resources to put ETFs to work. So let's change the page here. I'm going to take control, and here we are. I'm on the Fidelity website. I'm going to work with our Fidelity test account for today. So anything we look at, of course, is for illustrative purposes. As we start to dive a little deeper, I'll just share a little bit about my role. My role is to work with clients just like you. Anyone that likes to manage wealth on the Fidelity offering. How does our platform align with your strategy? Let's find ways to make it easier. Let's find ways to empower investors with information, so you can simply make more informed decisions and the best decisions for your wealth and your family. So I'm going to start with maybe just a slight overview of what this website is and just some general navigation. Accounts and trade is just very simply going to give you anything you need about your accounts. I want to see my positions. I want to place a trade. I want to pay a bill. I need a statement or a tax form. Or maybe I want to have my dividends reinvested or change them to pay out to cash. All that happens over here. Planning and advice is what our branch world lives by. I'm in the Burlington office. That's what we're doing all day in the Burlington office, is helping clients plan, and they're getting advice from our advisors. Always feel welcome to ask, and that's what we do. My world, I spend more time in this news and research row. So if you wanted information about a mutual fund, a stock, or an ETF, it's all found here. This gives us a good overview of what you can do at Fidelity. And then this gives you a good overview of why Fidelity. All right. So let's go to news and research, and let's go to ETFs. We're on the ETF Research Center. And let's take a look at some of the information that we can access here. So I took good notes. And remember, if you need the symbols, you can download the slides. I'm going to go over a few of the symbols that Mike talked about, and I'll go over how to find some of that information on those holdings. And then from there, we'll take a look at the portfolio builder tool together. So the way that I tend to start is where it says enter symbol or company name. Let's do this two different ways. If I wanted to find homework on, I typed it in wrong. See, it's correcting me. If you type it in right, you're going to get the name. And the reason why I'm showing you this is not only because if I know the name of the symbol, I can type it in. But if I don't know the name of the symbol, but sometimes I want to find funds that are focused on dividends or are focused on a theme like artificial intelligence, you can just search by keyword. I found that has been super helpful. So you can see when I just type in the word dividend, 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 Fidelity high dividend, there's the iShares dividend. So it's a quick, easy way to get some funds to start with. Then if I click in, if I wanted to find some other dividend growth funds, I can come to comparisons. And from comparisons, if I just scroll down, now you can see I have some other dividend funds right here that I can look at side by side. These are all hyperlinks to learn more about those funds, or I can type some of them in down here. What do we have? DLN. And maybe we try the HDV that Mike mentioned earlier. And what this will do for you is, instead of just being limited to these column headers here, if we scroll down a little bit down here, you're just going to have a lot more information about them. Instead of just looking at performance, I can look at total return. If I did want to look at yield, I can come in and I can look at all of these different characteristics right here on the same page. So that's one way that I have found my way around the platform to get different dividend focused ideas above and beyond some of the symbols that Mike shared with us earlier. But one thing he mentioned at the start of the presentation was, let's come in and look at distributions and expenses. How tax efficient has this fund been? And remember, when Mike was talking about tax efficiency, he was focused more on, we know the fund's going to pay a dividend, but is it also distributing a capital gain? And if we look at distributions and expenses, this is where we can see the history of the fund's distributions. So I'm going to make the font a little bigger for me. And we can see the green is dividend history, and there's no orange or yellow, which would be a capital gain distribution. This is where it can start to get a little tricky. The yield says 2.31. I thought Mike said it was over 3. It might be over 3. I'd have to check. But this is the last 12 months, the TTM. This becomes really important as you're looking at bond funds, maybe a little bit more than stock funds. But yeah, this is in the 2 range for this fund. Maybe it was the other fund that was higher, over 3. The 30-day yield, so if we looked at the yield over the last 30 days and annualized it out, is still around 2. And why is that more important for your bond funds? Well, as yields kind of go like this, if you're looking at the whole yield, the year, but if the rates have gone up, you're not getting a real indication of where rates are today. The 30-day yield will help you do that a lot. Let's look where we can find some more information about this fund, and then we'll dive into a build together. What do I like to look at? I enjoy looking at the fund's composition. The reason I like coming in here is because, first, we talked a little bit about style map. This is considered a large cap value fund, the one that we're looking at right now, even though it's got a focus on paying dividends. Let's say you did want to look at the prospectus. Here's where you'd find it. If I bought 1 share of this, I'm going to be buying this market cap weighting that's being added to my portfolio. Every cause has an effect. So every time I sell or buy something, it's making some type of change to my portfolio. Here's my holdings. I know I got the question in the chat. I'm interested in seeing overlap at a stock level. There's really no way to do that other than looking at holdings one by one. You can get that overlap view if you're looking at ETFs to ETFs, but you'd have to pull up the whole list and do it. In our analysis tool that we have, we'll show you overlap at the sector level, at the asset allocation level, but not the stock level, because the mutual funds aren't that transparent. That's the reason why we have that limitation. Here is your sector exposure, and then here's the style map. We said this is considered a large cap value fund. Mike, I don't know. Am I hearing you back with me? Do I have you back with me?
Yeah, I'm back. The virtual world wasn't cooperating. So,
That's
but
all right,
I did
Mike.
want to say the other thing to mention here, Don, in terms of like overlap within a portfolio, and this is something we talk about often as well, is when you're using ETFs, clients are using ETFs. There's several different index providers, right? So you can use a Russell, you can use S&P, you can use Morningstar, you can go right down the line, MSCI. We always say it's very important to keep it within the index provider. So for instance, S&P, right? You have the S&P 500, you have S&P mid cap and S&P small cap. If you build out those 3 ETFs like we showed before, Don, and say you give very simply 60, 20, 20, right? So you have that 100% allocation. You're getting zero overlap between large cap, mid cap, and small cap. So you're keeping it very that pinpoint exposure to those specific segments of the market. But if you start to mix in other index providers, you could potentially see significant overlap because each index provider, right, Don, has different rules of what a small cap is, what a mid cap stock or large cap. So you're mixing up these indexes, and you could see this overlap, unintended overlap.
Really good point, Mike, that I don't know that I would have thought of. So I'm glad the technology worked for you so you could come back in. You should always feel like you can interrupt me, Mike. So I'm glad I heard some noise in the background. Otherwise, I might have missed you there. Because I do see that from time to time, Mike, where investors might have a lot of different fund families built into their portfolio. I'm sure there's good reasons for it, but that might be one consequence is you might not knowingly get a little bit of overlap that you might not get if you are starting to build out using the same fund family. So thank you for bringing that up. Mike, let me show you where to find the ETF portfolio builder tool. If we go to news and research and then come back down to ETFs, because this ties into a lot of what the theme of the presentation was. You showed us an all-in-one. You showed us a two-in-one, right, where you could buy two funds, where you could get the ability to change the allocation, but you're responsible for more of the rebalancing to stay to your target. Then you gave us a bunch of ideas where we need to be a little bit more hands-on to get the asset allocation right. But if we wanted help with some of the numbers, you can, of course, come into our office and talk to our advisors about which asset allocation is right for you. But this is a great place to start, too. If you did know what allocation you're looking to model your portfolio by, we can come in here and just answer a few quick questions. So let's look at and say, what if we knew we wanted to be a growth investor, Mike? What does that mean? Well, that would mean here that we're looking at this mix of about 50% domestic stock, 20-ish% foreign, and about 30% fixed income. So now if we said, how do we get those funds? How do we get the right amount of those funds? A lot of the ideas might come from the slides you shared, Mike, but I'll use the iShares and Fidelity mix. And you can see how it's giving us some of those symbols, but it's also doing it with some weights here to help us out a little bit.
Hey, Don, how often do you if you're running through a tool like this, what type of investors are gravitating to, would use something like this?
Someone that wants to be more hands-on, right, Mike? They might want to manage the portfolio themselves. They might want to make the changes themselves. They might want to use this as part of their core investment. And then they might use something like a theme as a satellite investment, Mike. We get the question a lot about investing in artificial intelligence, or maybe I have some stocks that I'm comfortable owning, but I still want the core part of my portfolio in some type of diversified mix that's giving me the target that I'm comfortable with. Because it's not only giving me the potential for the growth that I'm comfortable with, but it's also managing part of the risk for me here too.
Yeah, I also see it. Investors that just, like you said, Don, want to be a little more hands-on. They don't necessarily want to have to pay, large fees for management and things like that. This could be a very good starting point. And even if you don't use this entire portfolio, right, it just gives you ideas as well. So this is a diversified portfolio. It's giving you all different exposures to the market. So it could be a good way to start to add in some of these, or add to some of the gaps within a portfolio as well.
Mike, this is our Fidelity test account that I'm looking at. And the reason I'm bringing us here is because if I come over here to more, and then I come down to analysis, sometimes it's helpful to know where I am. Unless I'm starting with cash, right? Then it's simple. I know where I am. You might start with cash if you had like a 401k rollover. Now you have a cash portfolio. It's easy to come in, maybe get an asset mix that I'm comfortable with, and then go in and implement. But for most of us, we're already invested. So then I need to know where I am to kind of think about what changes might I consider. The reason I bring us here is because this will do a summary of one account or multiple accounts all on the same page. And then we can come in and see multiple layers of analysis of a portfolio. So for example, if I wanted to view the asset allocation of this account or this portfolio, now I can start to see how much stock it has, how little international and how little bond. That might be intentional, but if I wanted more international or if I wanted more bond, now I might start to think about some of those symbols that we looked at earlier or finding something comparable to put in. This was found under accounts and trade, account positions, then more, and then analysis. We call this the guided portfolio summary, Mike. Other things that are in here, I can come to stock analysis, and we talked about stock style earlier. You know, this is that traditional style map. Sometimes you recognize seeing it, but might not recognize hearing it. The gray boxes on the right are the Dow Jones Total Market Index. The blue and white over on the left are the portfolio that we're looking at. We can do the same thing at a sector level and say, wow, I have 30% tech. Well, the market's about 30% tech. If you're comfortable being there, you'll stay there. If you want an overweight, obviously you'll buy more, but sometimes for investors, depending on where we are in the economic business cycle, they might consider adding or taking from different weightings here, Mike. Where are we on time? We got a few more minutes. Let me see if I can get you one last question, Mike, before we start to wrap up. And while I do that, let's see.
Well, what about you, Don? Can I ask you a question on AI? How do you find that? Anything similar, or is there a guide path to find? I know there's
there isn't. It's tricky with themes because a lot of our screens we can search for U.S. equity, international equity, municipal bond, corporate bond, like these traditional kind of filters. Even dividends, I kind of have to type in. But what I've always found is this search does such a good job, and I do a lot of searching up here too. So as I start to type in, you can start to see not just from iShares, but from any fund family, funds that have these keywords in their name. And now we can start to do our homework on these different funds to find which one might align with the way that I want to invest, and also just have the best characteristics for what I'm looking to do too. Where's the trading volume? Where's the expense? What's the rating? What's the country or in sector exposure? As I'm looking through a few of these here, I'll just highlight this one here real quick, Mike. As the iShare fund, you're going to know this fund better than me. So if there's any talking points you want to provide to it, I'll give the mic to you for a few minutes.
No, if you're looking for that type of exposure, Don, this is where you can gain that. I think what a lot of people are trying to do is like gain access to the NVIDIAs, right? Those type of investments across the board. But a lot of these funds will give you kind of the diversified value chain of AI. So it's not necessarily just one area. It's giving you exposure to kind of what we call the nuts and bolts, like what's driving AI, and it's giving you exposure to those types of companies as well. So this is a well-diversified kind of mix of companies that fall into that specific theme.
Other ways that you're going to find similar filters, maybe not specific to AI, but if you come into news and research and ETFs, Mike, on here is our screener. So when we come into the screener, some of the more traditional screens that we tend to look for now are, I'm looking for a healthcare fund. I'm looking for a technology fund. I can filter by sector. So let's say, for example, I do want to look at a healthcare fund. As I click in, this is a list of not just funds that track the whole sector, but the sector and more narrow. So you can start to see like biotech, medical devices. I'm sure pharmaceuticals is in here somewhere. Here we are. And depending on, again, what we're looking to solve for, this is a quick, easy way to filter and start here. Now, if we want to look for, of these funds, which ones are the most cost efficient, I can easily add something like net expense, come over here, add a sort, maybe not the most expensive, but we'll flip it to the lowest, right, Mike? And if we wanted to then say, okay, now that I know which ones are the most cost efficient, which ones are the highest rated by Morningstar, we could easily say, I'll just take the top rated ones and now I'll flip it upside down with expense. And you can start to see all the different funds that find their way in here. This little icon here is the Fidelity fund. That's why you're getting the green icon. Sometimes I get that question. Mike, we're right about at time, so I want to take a couple of minutes to thank you for being with us. Thank you for the opportunity to present with you again. I always enjoy spending time with you, hearing some of the things that you mentioned. We've done this, I don't know how many times, and you still say something that I might forget. So it's great to hear all your thoughts, and I know for our investors, it means a lot too. For all of our clients, thank you for being with us. Thank you for being a Fidelity client. If you attended all 3 sessions, thank you. It means a lot to have you here. Sometimes we get the question if these are going to be recorded or not. If they are, you're going to get them in an email. So you'll automatically get them emailed to you, all 3 of them, if you're registered for any one, if they are indeed recorded. And then you're going to get that email at the end. So if you can, open it, because it's going to lead to additional resources. Mike, before I wrap, I want to give you the chance to thank our clients, and then I appreciate your time.
Yeah, Don, it's always great being with you. I'd like to take the time to thank everyone. Hopefully, everyone can walk away with this where you learned something. And I would urge you all to reach out to financial consultants at Fidelity if you want to learn more. People like Don to walk you through the website, show you all the tools, things like that. So did want to say thank you to everyone. Really enjoyed the time. And Don, look forward to continuing these in the future.
Absolutely.